So first we will pick up SA 501. So what does SA 501 talk about? So if we look at the title of the standard, SA 500, what does that say? What does the title of the standard say? Audit evidence specific, 1 minute, specific considerations for selected items, no? Yes. Right. So here we have. So we will take the chart also simultaneously. Both we will keep it aside. Yeah. So we have SA 501, which is talking about audit evidence and special considerations for specific items. So basically, SA 501 is also the standard which is talking about audit evidence only. But you all will say, sir, we have already covered one standard regarding audit evidence, which is SA 500. Then what is SA 501 for? SA 500 is a general standard which is talking about overall audit evidence. What is the meaning of audit evidence? What are different audit procedures? What are different methods? What is sufficiency? What is appropriateness? What factors will affect? That is a very general standard talking about overall audit evidence. SA 501 is a standard which is talking about how to obtain audit evidence, that too not for all items, only for 3 specific items. Only for 3 specific items, how you are required to obtain audit evidence. That's what SA 501 is talking about. So how we need to obtain audit evidence regarding 3 specific items? What are the 3 specific items which they have asked? Number one is attendance, existence and condition of inventory. How you have to obtain audit evidence regarding existence and condition of inventory. How you need to obtain audit evidence regarding completeness of litigations and claims. And how you need to obtain audit evidence regarding presentation of segment information. So out of that, first thing we will pick up. How do you obtain audit evidence regarding existence and condition of inventory? So here they are talking about 2 aspects. You need to obtain audit evidence regarding existence and also condition. Existence is something. See, for example, if you find any stock value in your balance sheet, how the stock value will be derived? You have to determine what is the quantity of the stock available, that you have to multiply with cost or NRV, whichever is lower, but you will get a resulting figure that will be the inventory value. So if this inventory value is correct or not, that depends on whatever quantity that you have used in the valuation, that should be correct, and whatever cost or NRV which you are using, that should be correct. If we got to know that quantity is correct and this cost or NRV is correct, then obviously value of the inventory also will be correct. So when I say you need to obtain audit evidence regarding existence, I'm talking about quantity. You need to obtain audit evidence regarding the quantity, whatever quantity that has been used for the purpose of valuation, whether that quantity is really there with the company. And when I say you need to obtain evidence regarding condition, condition is something which will determine the NRV. NRV of the stock will depend on what? Condition. So as you all are aware, simple example if you have to take, simple vegetables example if you take, on the day they are brought to the market, they are superior condition, the NRV will be much higher, they will be able to sell it for more. One day passes, their condition will become deteriorated, the price will fall down. That price you are paying is nothing but NRV. Few more days passes, even NRV comes down even further. So when I am trying to obtain evidence regarding condition, I am trying to obtain evidence regarding that NRV. Cost is something you need not worry. Cost you can directly calculate from the books. So what is more crucial? NRV is more crucial. So if you obtain evidence regarding the existence and condition, obviously the value of the inventory will be correct. Now let me ask you. Okay, let us keep the standard aside. You tell me if you want to obtain evidence regarding existence and condition of inventory. If you are in the position of an auditor, assume yourself as an auditor. What you will do to obtain that audit evidence? So what you have to do is, first you have to go and attend. Unless you go and see that, you will not be able to see, you will not be able to know whether inventory is there, what is the condition of the inventory. If you want to know that, you have to go and see it. So what the standards suggest is, management will do inventory verification. Like even in CARO also we are required to report whether management has done the physical verification at reasonable intervals or not. And what is a reasonable interval for inventory verification? Once in every year they will do. And generally most of the companies will try to plan it around the year end. So many companies will do it as on 31st of March. A few companies will do 5 or 10 days before or after. So many of the companies will plan their physical verification near the end of the financial year. So every company will do physical verification of their stock. Now what the standard suggests is, as an auditor, you try to attend that management inventory counting process. So whenever management is doing physical verification, they will inform you as an auditor, you should try to attend that inventory counting process. Sir, what I should do by attending there? Just time pass, whatever we do regularly. So what you should do by attending that inventory counting is you have to evaluate the management process. So what processes management is following for doing that inventory counting. Then you observe. First you get the understanding of their plans. Then you sit and observe. According to the plans only they are doing the counting or they are doing counting in a different manner. Then inspect the inventory. So randomly walk here and there, just have a look on the inventory in what condition it is. And if you are even feeling more bored, perform test counts. Randomly you go to some items and do the counting on your own. Inventory counting will be interesting in some cases. So in some cases, in some clients, what they do know, they will have a very big warehouses and all, and inventory will pile up like very high ceilings will be there. If you want to really go into the stock, they will have some kind of this elevator kind of things and all. They will take you up, they will get you see there. So you can do a lot of time pass there actually, but you have to be very careful, right? So when you go for inventory verification to those places, when you go for inventory verification, no, you go in complete formals and all. For in the morning you get ready, go to the formals and attend the inventory verification. By the evening when you come out, no, you will also get mixed with that labor only. They will not be able to recognize that you are a chartered accountant or an auditor. So whatever it is, as an auditor, if you want to obtain evidence regarding existence and condition of the inventory, management will do the inventory counting. You should attend. By attending there, you should do 4 things. What are they? Evaluate the management's process, observe the management counting, inspect the inventory, perform test accounts. One thing which I got worried a lot by looking at one question in the examination, either in RTPs, MTPs, I don't know. They have asked one question in the MCQs. What is the question? As an auditor, you go and attend the inventory counting process. By attending the inventory counting process, you should do 4 things. Identify which 4 things you should do. 4 options I have given. In each option, you are able to find the 4 things. In every option, all the 4 things are there. But how the options are structured is option A, evaluate, inspect, test count, observe. Second option, observe, evaluate, perform test count, inspect. Order. In what order? So you have to choose the correct order. So evaluate, observe, inspect, perform test counts. I told the answer here. Okay. So this is the order. Evaluate. Evaluate, observe, inspect, and perform test count. So that order, correct order, you have to find it out and you have to write the answer. So I felt very bad looking at that question. For a moment, I felt like I should quit the teaching and all. I can't see all these horrible things happening. I felt it is really worse question here if you ask me. Hey, why I should do that in that order only? Huh? So first I will evaluate management plans. Okay, then I will sit and observe. I will perform test count, then inspect the inventory. What mistake I have done by doing that? Nothing, no. So, but still they expected an answer. They're not just expecting you to remember the points, but in one case they have even expected you to remember order also. How mean, no? Right. So whatever it is, fine. So let us keep all our worries aside. Let us come back to the concept. If we keep on cribbing, there are many things to crib. One after the one, so many things will come. So let us proceed. So first you will attend and do these 4 things. And one more thing they say here. In case if the inventory verification is happening on the balance sheet date, well and good. Whatever stock which is there on that date, if you are satisfied with that quantity and condition, no issues, you will be happy. Sometimes inventory verification will happen on other than balance sheet date. Say for example, management is doing the physical verification on 10th of April. On 10th of April, they are doing physical verification. You attended there. On 10th of April, whatever condition is there, whatever quantity is there, that is matching. But with that, your responsibility will not come to an end. Why? Because the stock which is there on 10th of April will not come in my balance sheet. The stock which is there on 31st of March will come in my balance sheet. So now you have to do the calculation, reverse calculation you have to do. So if stock on 10th of April is matching, intervening transactions from the date of the balance sheet till the date of that counting, whatever intervening transactions are there, that you need to recalculate. That means you need to add whatever sales which have taken place from 1st of April to 10th of April. You need to reduce whatever purchases which have been done from 1st of April to 10th of April. Then balance stock you have to see, that is a stock as on balance sheet date. Now whatever these additions or deletions which have taken place between these dates, whether they are genuine or not, that also we need to obtain audit evidence. Clear? So whatever it is, management will do physical verification. They will invite you, they will call you, you please go and attend that inventory verification. Next. Sometimes what will happen is management will do physical verification. They have even invited you, but you are unable to go and attend that inventory counting. You are unable to go and attend that inventory counting. Then what you should do? Then you alone should go and do then you on your own, if you are unable to go on the date of inventory verification done by the management, then on some alternative date, you plan the inventory verification with your team. But when you go there, no need to do 100% verification. On a sampling basis, you do the counting. That's what you should do. Then in case you are unable to attend the inventory counting process by the management, later you thought of attending, but it has become highly impracticable for you to attend that inventory verification process. You did not go when the management invited. You thought, okay, I will go after some time on my own with my team and do the test count. But that has become highly impracticable now. You are unable to do it. So, sir, what do you mean by impracticability? Can the auditor say the warehouse where the stock is kept is 50 kilometers away? I have to spend one day to go and verify that stock. That is a reason for impracticability. I will not do. Can he say that? When we say impracticability, that should have been caused by circumstances beyond the control of the auditor. Difficulty of time, difficulty of cost, they are not considered the reasons for impracticability. Able to understand? So you need to compulsorily go and attend the inventory verification on your own if it is, unless impracticable. If it is impracticable, then what I should do, sir? Sir, impracticable examples of impracticability will be like natural calamities, social riots, it could be there, or some dangerous places. Your stock is very dangerous. You can't go and physically verify. Say, for example, your client is dealing in some chemical products. So those chemical products, they are having some hazardous products. They said that some 200 kgs of some material is there. You can't go in surroundings, in proximity, you can't go to that chemical. Even if you go to the proximity also, you have some hazardous effects. So there you can't verify. So that is a reason for impracticability. Sir, I did not attend management's inventory counting process. I thought of going it on my own, but that has become highly impracticable. Then what I should do? Then the standard says try to perform alternative audit procedures. Think, apply your mind. What else you can do apart from doing physical verification? Can you do anything else to obtain audit evidence? Sir, what I can do, that is up to your choice. Sir, someone has come and told, sir, I will do a video call and see. If you feel that will give you audit evidence, do it. Sir, I am unable to attend, but I have a known person, I have a local person there who can go on my behalf. Natural calamity is there on the way. I can't go, but I know a person at that location where a warehouse is there. I will send that person. Do it. So whatever it is, try to do alternative audit procedures to obtain audit evidence. Sir, alternative audit procedures are also not possible. Might be you thought of alternative audit procedures, but they are not giving evidence. Or you did not come across any alternative audit procedures only. Then what you should do? Modify the opinion. Then you don't have any option. You have to modify. Which kind of modification you will give? Which kind of modification? Not disclaimer. I told you, no. You told whenever there is no evidence, you will directly jump to disclaimer, but it is not the case. Here it could be either a qualified or disclaimer. If the possible effect of that inventory is only material but not qualified, if the possible effect is material and also, then what is? Then disclaimer we are supposed to do. Understood? Clear and comfortable? Right. Next. In addition to that, they say one more thing. When you go, now if you come to the material, when you go and attend the inventory counting process, there are some matters which you have to pay attention. What are the matters which are relevant in planning attendance at physical inventory counting? So what matters you have to pay attention? You have to pay attention to what is the nature of inventory. Is it work in progress? Is it finished goods? Or is it raw material? You have to pay, if it is work in progress, what is the stage of completion? 30%, 50%, 60%. What is the stage of completion? So that you have to pay attention. Risk of material misstatement. Keeping in mind the inventory, what is the risk of material misstatement here? And also nature of internal control. The place where they are keeping the inventory, what kind of internal controls they have. Whether there are adequate procedures and proper instructions, the staff who are involved in the inventory counting, to them proper instructions have been given or not. The timing, at what time you are doing that physical verification. whether the entity maintains perpetual inventory system, how they are maintaining the records. Generally, they should maintain perpetual inventory records, not periodic. And the location where the inventory is held, because of that location, is the inventory facing any challenges? Is the inventory facing any risk? And also whether the assistance of an auditor's expert is needed. Sometimes to obtain evidence regarding inventory, you might need the assistance of an expert, especially when the quantity is in the form of liquids. Like oil refining company, you are doing the audit, they store the oil in very big containers. The container will be equal to the length of a building and all. They say in this container we have 2000 liters of oil. You have to measure whether really 2000 liters of oil is there or not. What do you do? Take a bucket, tie a thread, tie a rope, and start extracting. Can you do that? No. So you have to take an expert of engineers. They're depending on the dimensions and all, they will give you some kind of estimation. So like this, whether you are required to take any help of the expert, that also you have to pay attention. So these things you will try to obtain, these things you will do to try to obtain audit evidence. Sometimes what will happen is your client is owning a stock, but that stock is not with your client. That stock is held in possession, is in the custody of a third party. Someone else is holding that stock. Now what auditor should do? In case if the inventory is getting held by some third party, so for that also you need to obtain audit evidence. So how you will obtain audit evidence? You will try to obtain external confirmation. Generally, external confirmations will be reliable. See, when this circumstance will arise is in the case of job work, in the case of goods sent on consignment, in the case of goods sent on sale or approval basis. So in those cases, this thing arises. So in those cases, for that also we need to obtain audit evidence. But first thing what we do, external confirmation we do. Generally, external confirmations are reliable, but in some cases, external confirmations are not reliable. When the third party from where the stock is kept, they are not independent, then you need to perform alternative audit procedures. What alternative audit procedures you can do? If possible, you go and attend there. If the time permits, you go and travel. If you know somebody else, go and ask them to go on your behalf. So like that, whatever you feel appropriate, in addition to external confirmation, that extra procedures also you are required to perform. Clear? So this is what SA 501 says regarding obtaining of audit evidence relating to existence and condition of inventory. Second item regarding which you need to obtain audit evidence. Second item regarding which SA 501 is giving guidance. What is that? Completeness of litigations and claims. Whether management has completely whatever litigations and claims the company is going through, the client is going through, without ignoring, without leaving anything, everything should have been presented in the financial statements. See, every litigation and claim, if because of a litigation and claim, if we know that we are going to compulsorily lose the case, that will be shown as a provision. That amount will be shown as a provision. If outcome is uncertain, then it has to be shown as a contingent liability. But somewhere litigation and claim should be completely presented. So as an auditor, you should obtain audit evidence whether the company has disclosed all the litigations and claims either in the balance sheet or in the notes to accounts, and whether have they hidden anything from you, that you need to obtain audit evidence. Sir, how I need to, what steps I need to do in order to obtain the audit evidence? First, the standard says don't directly go for finding out the misstatement. First, you try to find out, is there a risk of material misstatement? Is there a risk of material misstatement regarding litigations and claims? What do you mean by having a risk of material misstatement regarding litigations and claims? Is there any chance that the management could have hidden some litigations and claims? Find the risk. Sir, how will I find the risk? They say 3 steps you have to perform to find whether there is any risk of material misstatement regarding. Listen carefully, guys. Listen. Don't put your heads down. Listen carefully. So you need to first identify risk of material misstatement. They are not asking you to directly identify misstatement. First, they are asking you to identify risk of material misstatement. How can I do that? By performing 3 steps. First, they are asking you to do 3. What exactly you need to do? They are saying here. So 3 things they are asking you to perform first. What is that? Inquiring with the management and in-house legal counsel, internal legal department and the management. Go and inquire with them. Sir, did you completely disclose all the litigations and claims? Go and talk with the legal team also. Then read the minutes of those charged with governance. Top level management might have conducted the meetings. Go through the minutes. Third one, review legal expenses. What are the legal expenses in the current year? What are the legal expenses in the past year? Do the comparison. If there is any significant increase, there should have been new cases, whether that has been disclosed or not. Clear? So 3 things you are required to do. What are the first 3 things you are required to do? Number 1, inquire with management and in-house legal counsel. Number 2, read the minutes of those charged with governance. Number 3, review the legal expenses. These 3 why we are doing? To identify risk of material misstatement in the area of litigations and claims. Now, by following these three steps, two outcomes could be possible. What two outcomes could be possible? There is a risk of material misstatement, or there is no risk of material misstatement. If you are satisfied after following the three steps, you are satisfied that there is no risk of material misstatement. I did not find any risk there. I did not find any chance management hiding. I felt genuine. Management has disclosed all the litigations and claims. You aren't supposed to do anything. Your activity will get completed there itself. Done. If you don't find risk of material misstatement, your responsibility is over. But in case if you find the risk of material misstatement, you perform at these three steps. But if you found the risk of material misstatement, yes, there is a chance somewhere some suspicion is there that management might have hidden some litigation sentence. Then you need to perform further audit procedures. Then you need to perform further audit procedures. So what further audit procedures you have to perform? Like even if you see in the chart here, I have specifically mentioned only if there is a risk of material misstatement. No risk of material misstatement, nothing. Your process will end here only. If risk of material misstatement, perform extra. What you have to perform? Number one, auditor shall communicate with entities external legal counsel. You have to go and communicate with the entity's external lawyer. For the purpose of fighting the case, they might have recruited the lawyer. Go and consult with the entity's external legal counsel. But if you go and ask something to the entity's external legal counsel, they will not respond to you. Why? Because you are not the person who are paying them the fees. So if you need information, when entity's external legal counsel will give the information? Only when you have some kind of approval from the management. Or management will better know if you ask the information in what manner you will get the reply. Yes or no? So I am helpless here. I have to go and take the help of management. So what I should do? How I will take the help of management is, see, generally I will try to communicate with the entity's external legal counsel through a written letter. But I don't know how, if I ask to whom to address, I will get the information. So for this I have to take the help of management. So I will ask the management. I will tell them the content. I will ask the management to draft that letter of inquiry. So auditor will try to communicate with the entity's external legal counsel through a letter of inquiry prepared by the management, sent by the auditor, and asking the entity's external legal counsel to reply back to the auditor directly. Three things. The auditor will communicate with entity's external legal counsel through letter of inquiry prepared by, sent by, and asking the entity's external legal counsel to reply back to. Perfect. Now, after you have sent the letter of inquiry, two things can happen. One, what is the first one? Entity's external legal counsel has communicated. He gave the reply. Now we will analyze the reply. On the basis of that, we will form the conclusion. So this audit will proceed normally. So when there will be an obstacle, that means you are not getting reply from the entity's external legal counsel. Not getting reply from entity's external legal counsel might happen because of multiple reasons. Number one, first, management itself did not cooperate with you to send a letter of inquiry. Number two, management helped you through a letter of inquiry, but the external legal party, he is prohibited from the law or regulation. Like we have confidentiality, even lawyers also will have confidentiality. So that external legal counsel is prohibited from responding, or external legal counsel intentionally he is not providing, even though there is no prohibition, he is not responding. Any of these three cases, either management did not help you out to draft the letter of inquiry, management helped you out, but the external legal counsel is prohibited from responding, or he is not responding out of his own. In any of these cases, you will not be able to get a reply. Now what you should do? Now the standard says perform alternative audit procedures. What you should perform? Alternative audit procedures you have to perform. Now once again, it is up to your choice. What alternative audit procedures you will perform, that you decide and do it, but try to perform alternative audit procedures to get the audit evidence. Now, if alternative audit procedures are also not possible, then what you should do? Then you have to give a modified opinion. Which kind of modified opinion? Qualified opinion you are required to give. Qualified or disclaimer of opinion you are required to give. In addition to that, even you are required to obtain written representations from the management that they have completely disclosed the litigations and claims. They did not hide anything. Ask the written representations also. And in some cases, you might feel that just communicating through letter of inquiry alone will not be enough. Sometimes you will feel the need to go and meet with the entity's external legal counsel directly. The standard says you have to go and meet with the entity's external legal counsel. You have to communicate with the entity's external legal counsel through letter of inquiry. But sometimes as an auditor, you might feel that communicating through letter of inquiry alone will not be enough. You might be required to go and meet with him personally. When that need arises, So here they have given, if you find that that risk is a significant risk, the legal matter is very big legal matter, it is a very significant risk, then not just communicating with letter of inquiry, you can go and meet him personally. And also matter is complex. Matter is very difficult to understand. That legal issue is very difficult to understand. Through letter of inquiry, you are not getting clarity. Then also you can go and meet with the entity sectional legal counsel. Or if there is a disagreement between management and entity sectional legal counsel, that means management told something, we sent a letter of inquiry, he gave a reply. Whatever entity sectional legal counsel is saying, whatever management is saying, there is a difference. There is a conflict. Then also you can go and personally meet with him and clarify the issue. So these are the three circumstances where the auditor might feel a need or urge to go and meet that entity's external legal counsel when the risk is a significant risk, when the matter is very complex, when there is a disagreement between management and entity's external legal counsel, then you can directly go and meet that entity's external legal counsel. Generally, the entity's external legal counsel will not meet you directly. For that also, he will ask you to get the permission of the management, or he will ask you to bring some representative of the management. So then you have to go to that fellows and ask them, hey, come useless fellow, he's not meeting me. He's not meeting me along without you. Please come, we will go and meet him. You have to take him and you have to go and meet him. Clear? And one more small thing is also there here. This is not covered in this chart. A small thing. General letter of inquiry, something will be there. Yes. Yeah, here. So this one. Sometimes what will happen is you might not be able to communicate through a specific letter of inquiry. I told you are required to communicate with the entity's external legal counsel through a letter of inquiry. But sometimes what will happen is, like if you read this phrase, it is considered unlikely that entity's external legal counsel will respond appropriately to a letter of general inquiry. So basically, first you will send, sir, what and all cases your client is going through. I'm an auditor of this company. Give me a list of all the cases which your client is going through. Now, external legal counsel will say, get lost. See, he will not respond to the general letter of inquiry. Anybody will have a doubt? No. See, for example, if someone is asking, tell me what and all your client is doing. You are doing audit of some company. Tell what are the various sources of revenue your client is having. Will you just like that reply? No. Even external legal counsel also will be very unlikely to respond to a general inquiry. So in that case, what you should do is you should make a specific inquiry. If you ask him broader things, he will not respond. He will have a doubt why this person need all this information. But instead of that, what you should do is you should ask him a specific inquiry. If you send specific inquiry, the chances of reply are very higher. So for this purpose, a letter of specific inquiry includes the list of litigations and claims. Basically, not the entire list regarding is there any specific doubt you have regarding certain litigation. So that list of litigations you can include. Where available, management's assessment of outcome of each of the identified litigation. You will also mention in that letter of inquiry, sir, these litigations the company is going through. When I ask the management is saying this. They are telling that there are more chances for winning. That's why they did not show it as a provision. They are showing it as a contingent liability. Management is saying this. Then a request that entity sectional legal counsel confirm the reasonableness of the management assessment, and you request the entity's legal counsel, sir, management is saying this, whether is it acceptable or not, or do you have any contrary view. So if you draft the inquiry letter specifically like this, the chances of getting the reply are very higher than the general inquiry. So if you have decided to send the specific inquiry, these are the things which are required to be included in the specific inquiry. What are they? List of litigations and claims. Number 2, management's assessment. Number 3, requesting the entity's external legal counsel to comment on reasonableness of management's assessment. Understood? So 2 aspects we have covered. Now we are left with last aspect. What is that? Segment information. So whether the management has presented the segment information properly or not, here I have nothing much to explain. Basically, we have an accounting standard talking about the segment information. So whether that requirements of the segment information standard has been complied with or not, we need to check. So as per that AS 17, we have a primary segments and all. We have how to identify the primary segments and all. They will give you criteria. Whether that criteria has been followed or not, we will check. And whatever calculations they have done, is it as per the standards or not, we will check. And if time permit, if suitable, we will also try to perform analytical procedures on the segment information. Like for example, if the business is having, if the client is having multiple businesses in the current year, like Reliance only you take. Last year from petroleum from petroleum segment, they have generated 70% of the revenue. In the current year, they have generated only 60% of the revenue. So I will do the comparison. Why there is a fall? Is it a genuine reason or is it any misrepresentation? So like this, I will try to dig deeper and get the information. Understood? So this is what you are supposed to do regarding segment information. Understood everyone? Shall we proceed further? So that's all. SA 501 has been completed. Now we will talk about SA 505. We will try to discuss, which is relating to external confirmation. So what does this external confirmation talk about? So first we need to be clear about a few definitions. So what is an external confirmation? If you remember, external confirmation is one of the method for obtaining audit evidence. We have discussed the 7 methods. In that, one of the method is what? External confirmation. So what is the meaning of external confirmation? So external confirmation means it is a direct written response. And one important thing you have to keep in mind, if you are getting oral response, that will not be considered as external confirmation. In order to be considered as external confirmation, that response should be a compulsorily a written response. Whether you will get that written response in paper form or electronic form, that is up to your choice. But that should be compulsorily in written format. If you get an email, yes, external confirmation. If you get a WhatsApp message, yes, external confirmation. If you get confirmation over call, not an external confirmation, because it must be in a written format. So auditor getting a written response either in paper or electronic form from whom? From a third party. Which third party? Other than auditor and the client. Other than auditor and the client, from a third party like debtor, creditor and all, from banker, etc. From the third party, whatever direct written response which auditor is getting, that we call it as, and third party we also call it as confirming party, and that written response we call it as external confirmation. And now these confirmations you can get it in two ways. As an auditor, if you want reply, basically in external confirmation, we will ask the information from the other party. We'll ask the confirmation from the other party. That letter which you are sending, that we call it as confirmation request. You want written response, no? For getting that written response, you have to first ask the information, either by way of email or letter. That request which you are sending for response, that we call it as confirmation request. And that confirmation request can be of two types. What is that? Positive confirmation request, negative confirmation request. What is a positive confirmation request? In your confirmation request, if you are expecting a third party to respond whether he agrees or disagrees. If he is agreeing also, you are expecting a reply. If he is disagreeing also, you are expecting a reply. Then we call it as positive confirmation request. Then what is negative confirmation request? You are expecting the other party to respond only when he disagrees. So you have to determine whether a request is a positive confirmation request or a negative confirmation request depending on the wording used in the confirmation request, not on the basis of you are getting reply or not. So you have to decide whether a confirmation request is a positive or negative depending on expectation of the auditor, what he is expecting. If he is expecting the third party to respond, either he agrees or disagrees, then it is a positive. If he is expecting a reply only when the third party disagrees, then it is a negative confirmation request. Understood? Then, say for example, one auditor is sending the confirmation request like this. He is saying in the confirmation request, sir, I am the auditor of so and so company. I came to know that you are a debtor of my client. Please tell me the amount you are due to my client company. Positive or negative? Understood the question what I am asking? See, I am not asking him for a confirmation. What I am asking, sir, I am an auditor. I am an auditor of your client, of my client. My client says you are a debtor. Please tell me what is the amount you owe to the company. Positive or negative? Positive. Why? Because here also I will get response. I'm expecting response in all the cases. I'm not asking him yes or no. I'm asking him to directly provide information. So there also I'm expecting response in all the cases, no. So that will also fall under positive confirmation request. Next, one more term which we need to understand is exception. Exception means what? Exception means mismatch basically. Say for example, I send a confirmation request asking my debtor, sir, I'm an auditor of so and so company. My client says that you are a debtor. You owe them 1 CR. You owe them 1 CR. Your outstanding balance in their books is 1 CR. But the debtor replied me back, no sir, I am not required to pay 1 crore. I am required to pay only 80 lakh rupees. So information, whatever is there in the confirmation request and whatever response you got from the third party, both are not matching. There is a difference. That case we call it as exception. So here I have an exception. So whenever you come across exception, will you automatically conclude that it is a misstatement? Does an exception always mean a misstatement? No, exception doesn't always mean a misstatement. Exception can also be because of third party's mistake also. when a difference you have got, you don't automatically come to the conclusion that your client has only done a mistake. Sometimes exception might arise even because third party has made a mistake in his books of accounts. So exception doesn't always mean a misstatement. When you come across exception, you have to put that extra effort to determine, is that exception a misstatement or not a misstatement. Then one more definition, you need to understand what is the meaning of non-response. What do you mean by non-response? So non-response means one simple thing. You sent a confirmation request, but you did not get the response. This is what generally we assume. But they define this in a detailed manner. Number one, you sent a confirmation request, but it got returned undelivered. You sent a confirmation request, either positive or negative. You sent a confirmation request, but you got it was not delivered, you got it back. Like you sent a post, you got it back. You sent an email, you got a message that the message was not delivered. This we call it as non-response. Or you sent a positive confirmation request. What? Positive confirmation request, and you did not get the reply. Then also we call it as a non-response. If I send a negative confirmation request and if I did not get reply, that also will I consider it as non-response? That you can't consider as non-response. Why? Because in the case of negative confirmation request, that will be considered, the other party is required to reply only when he disagrees. If you don't get the reply, that means he has agreed, that you can't consider it as non-response. So non-response covers two cases. Number one, confirmation request got returned undelivered, either positive or negative. Number two, you sent a positive confirmation request, but you did not get a reply from the third party. Understood? Clear about all the five definitions? Then now let us come to what are the various steps which are involved. If you want to get a proper response from the external confirmation, what and all are the steps which you are required to follow? It involves four steps. Number one, you have to determine the information regarding which information you want to send the confirmation request. Number two, you have to select appropriate confirming party. Number three, you have to design the confirmation request. Number four, you have to send it and do the follow-up also. Let us talk about the first one. What is the first one? Determining the information regarding which you want the confirmation. See, mainly we use external confirmation for confirmation of balances. There is no doubt about it. What is the debtors balance? What is the creditors balance? What is the bank balance? So we mainly use that confirmation request for quantitative balances. But do you think the use of external confirmation is restricted only to quantitative things? We can also use it for qualitative aspects, like whether the customer has really given a discount or not. If the property is pledged with the bank, really the property is pledged with the bank or not. Do the bank has ownership documents or not? These kind of things also you can get a confirmation by way of external confirmation. So you can use it for both qualitative as well as quantitative aspects. So whatever it is, first you will determine regarding which information you want to send the confirmation request. Number two, you have to select appropriate confirming party. So you have to choose to appropriate person you have to send. Why? Because if you send the confirmation request to inappropriate party, you can't expect a reply. Even if you expect a reply, even if you got a reply also, that is not reliable. Only when the confirmation request has been sent to appropriate recipient and you got a reply from that appropriate confirming party, then only reliability will be there. Next, third step. Okay, you decided who is the confirming party, got his communication details, and you have sent that. You have identified the party. Now, what is the third step? Design. Now you have to take a decision. Should I go for positive? Should I go for negative? And what various factors you will consider, like risk of material misstatement you will consider. If the risk is high, positive confirmation request. If the risk is low, negative confirmation request. You should also decide on presentation. So you have to send it on paper form or you have to send it on electronic form. That also you have to decide. Even in taking the decision, you can use your past experience also. You can use your previous experience. Whether if you send it by post, you will get a reply, or if you send it by email, you will get a reply. You use your past experience as well. It also depends on the assertion, that respective item of the financial statement. On that also you will decide. And even you have to decide on method of communication. So, and also management authorization. Sometimes what some third parties will do is, if I am an auditor, I send a confirmation request to the debtor. Debtor will see the mail. He will reply back saying why I should believe you are an auditor, why I should reply. That he is having so much of time. If he doesn't feel me as a genuine, he should have ignored. But what that person will do, he will even reply back. Why I should trust you are a genuine person? Why I should trust you are an auditor? Let us do one thing. You get the approval of the management that you are really an auditor. Then only I will reply back. Now you don't have any option. What you should do? You have to include the management approval, then send the confirmation request. And also you need to decide whether you want item wise details or you want total information. Say for example, some person from some debtor you want balance confirmation. Instead of asking, you know that debtor is a genuine person, good person, you have already past experience with him. Whatever information you ask, he will share. From that people, you can ask invoice wise details also. He will give a confirmation. Now, some people will be frustrated people. If you ask balances only, they will not reply. Very rarely reply. For those people, if you ask invoice wise details, they will even look your mail, delete your email. They will not reply. So you need to decide whether you want invoice wise details or you want total balances confirmation. Keep all these factors in mind, then design your confirmation request. Okay, after designing, what you will do? Keep it safely in the locker. What you should do, you have to send it, and you have to do the follow-up also. In which kind of confirmation request you do the follow-up? In the positive confirmation request, we do the follow-up. For negative, we don't do the follow-up. Why? Because if we don't get the response, we generally imagine that the third party has agreed with the information. Next, now between positive versus negative, which one is more reliable? Positive is more reliable. Negative confirmation request does not give that much persuasive evidence. Persuasive, what is the meaning of persuasive? Convincing. Pervasive is different, persuasive is different. See, positive confirmation request, you get more convincing evidence, whereas negative confirmation request will give you less convincing evidence. Does that mean should you not use a negative confirmation request at all? No, you can use it. You can use a negative confirmation request only when certain things are present. And in fact they use the phrase, don't you you can use negative confirmation request as a sole substantive audit procedures only in few cases. Only in few cases you can use negative confirmation as a sole substantive audit procedure. Always using only negative confirmation request is not correct. You can rely only on negative confirmation request only in few circumstances. What are the circumstances? Risk is very high. Sorry, risk is very low. The items are very small, minimal balances, and also homogeneous, small and homogeneous populations, they say. And few more things, low exception rate. In that area, you don't expect any kind of differences. Generally, they will be matching only. So then also, like for example, if you take bank balances and all, there is a very less chance for exception because mostly they will match. And also, recipient doesn't disregard the request. So what do you mean by this is, you know the recipient very well. As an auditor, you know the recipient very well, that if I send a message, he will definitely respond. If something is wrong, he will definitely respond. He's not a person who will ignore the messages and mail. You know that third party very well. If you know that third party very well, then also you can send a negative confirmation request. If you trust him so well that he will definitely look at the mail, and if he finds something is in problem, definitely he will reply. That much confidence if you have on the third party, then also you can send a negative confirmation request. And also wherever controls are effective. So you can use negative confirmation request as a sole substantive audit procedure only when these things are present. In other cases, you can't rely only on negative confirmation request. Either you have to go for positive confirmation request, or you should use negative confirmation request in combination with other methods. Sir, I want to send a confirmation request, but management is not allowing me to send a confirmation request. Who are the management here to stop us? How they can the question is, why they will stop us? Why do we need their permission first of all? See, stopping in the sense, how they will stop is, as a part of this external confirmation process, we rely on management. Whether you agree or not, we have to rely on the management. At which step we become rely on the management is in the second step. You have to select the appropriate confirming party. Your client has done a business with them with very big company. Now you want to send a confirmation from that big company, from that customer, but you can't send the email to their official email address because they will not respond. So you need to find out, for example, if your client has done sales to them, that means it is a purchase for the third party. You need to know who is that concerned purchase head of that third party and what is his email address. You have to get it. That without the help of management, you can't get it. So yes, more or less, whether you agree or not, in order to send the confirmation request, we need the help of the management. But sometimes management will refuse. So you go to the management and say, sir, I want to send confirmation request to your creditor. I need his details. I need his email account. then the management is saying, no, we will not share with you the details, or they will request, sir, please don't send the confirmation request. Then what you should do? First, you should understand the reasons why they are stopping you from sending that external confirmation. Why they are stopping you? Get the reasons. If there is a valid justification, what you do is try to perform alternative audit procedures. If you are unable to perform alternative audit procedures, you will give a modified opinion. However, if there is no reasonable justification, management is not giving any reasonable justification. They told, sir, don't send external confirmation. I asked them reasons. They are not at all giving me any reasons, or they gave me some reasons which are not at all acceptable. Then what they're asking you to do is reassess your risk of material misstatement. You might have done the risk of material misstatement assessment at the beginning of the audit. Reassess the risk of material misstatement. Why? Because now you got to know about the true nature of the management. Earlier they are saying yes to everything. Okay, sir, do whatever you want. But now they have come to you and showed that true color. No. Now they are telling, when you want to communicate with the third party, they are coming and telling you, no, don't communicate, and they're not telling me any valid reason. Now you got to know extra information regarding the management. Earlier you might have thought risk as low, but now you got to know about the management's nature. Now you should reassess your risk of material misstatement. You should consider the risk as very high. Increase your audit procedures. So reassess your risk of material misstatement, especially risk of fraud, and communicate this matter with those charged with governance, and even if required, modify the opinion. And whatever evidence you are getting it from external confirmation, you are required to evaluate it. What you are required to do? You are required to evaluate whatever evidence you have got it from obtaining external confirmation. So that one last paragraph will be there. So like as you could see, whatever evidence you are getting, that you need to evaluate. So the auditor should evaluate whether the results of the external confirmation procedures provide relevant and reliable audit evidence. Whatever responses you have got from the third parties, are they reliable or not? You need to check it. And when evaluating the results of individual external confirmation requests, the auditor may categorize such results as follows. Whatever responses you have got, you need to categorize them. How you have to categorize? A response by the appropriate confirming party indicating agreement with the information provided in the confirmation request. That means no exception. Everything is matching. See, basically you sent 100 confirmation requests. You got the responses. Now you need to segregate, no? For which, how many confirmation requests are there where the third party has agreed? Then a response deemed unreliable. You got a response, but the third party is not independent. You have a suspicion. Even though he gave a response, even though he told everything is correct, but it is not reliable. That you keep it aside. Then a non-response. You send a confirmation request but did not get any reply. That you keep it aside. And a response indicating an exception. Nothing but differences are there. So you get all the external responses, collect all the external responses and segregate them, categorize them. On what basis? Into 4 categories. Into 4 categories you have to aggregate, you have to separate them. What are the 4 categories? Those which are matching. Those where there are no discrepancies, everything is matching. Those responses which are considered non-reliable. No responses or exceptions are there. So into 4 categories you have to segregate. Then the auditor's evaluation, when taken into account with other audit procedures, it will assist the auditor in concluding whether sufficient and appropriate audit evidence. Now, after categorizing into all these 4, analyze them further and finally arrive at a conclusion whether this external confirmation has given you sufficient and appropriate audit evidence. If you feel that no, external confirmation has not given me sufficient and appropriate audit evidence, perform additional procedures. Clear? Other methods also you take the help of. Understood? So this is how you need to evaluate the responses to written representation, external confirmations. Understood? Clear? Shall we proceed further? Next. So now what we will do is 580 we will do. Very much related to 505. So I say 505 is external confirmation. 580 is written representation. That we will try to do now. Right. So what is written representation? What is the meaning of the written representation? It is also basically a confirmation, a written statement which is obtained by the auditor. External confirmation, we are getting a written response from a third party, but written representation, we are getting it from a management. So written representation is a statement, is a written statement received by the auditor from the management regarding what? Regarding confirmation of certain matters. You need confirmation regarding certain matter from the management. You want the management to confirm certain things. So you ask them to confirm them in a written manner through a written statement. and also to support other audit evidences. You have got some evidences, but you want some supporting information. So to support other audit evidences also, you can ask a confirmation from management. So written representations are written statements obtained by the auditor from the management either to confirm certain matters or to support other audit evidences. Now, can you use written representation as an audit evidence? Yes. Written representation is an important audit evidence like inquiry, but the problem is written representation does not provide evidence on its own. Written representation does not provide evidence on its own. What do you mean by that? You can't rely only on written representation. Written representation is just a supporting evidence. You can't rely only on written representation, but you have to use that phrase, terminology. So written representation does not provide evidence on its own. The other way of saying that is written representation do not provide evidence, you can't only use written representation as audit evidence. That is also same meaning. That is also same meaning. But you should not write it. What you should write in the examination? Written representation does not provide the evidence on its own. Understood? Next. Sir, what are the objectives of the auditor? As per SA 580, from whom, regarding which matters you need to obtain written representation. So SA 580 says, regarding 2 matters it is compulsory. Not 2 actually, regarding 3 matters it is compulsory. Number 1, every auditor should ask the management to give a written representation whether management has fulfilled their responsibility for preparation of financial statements. Every auditor should ask the management to give a written confirmation that whether they have fulfilled the responsibility for preparation of financial statements. And also every auditor should ask the management to give a written representation regarding completeness of information provided to the auditor. Basically, you should ask the management, sir, did you completely provide the information to me regarding anything? Did you completely provide the information to me? Management will say yes. They will nod their heads. Stop them to nod the heads. Ask them to write it on the piece of paper and give it to me. So 2 matters: compulsory written representation. Number 1, whether management has fulfilled their responsibility for the preparation of financial statements. Number 2, whether management has completely provided the information to the auditor. Third thing where it is mandatory is if there is any requirement of other standard. In other standard, if they are asking you to get the written representation regarding that matter also, you need to obtain. Just now we have seen SA 501. There we have seen the second aspect, completeness of litigations and claims. There they have asked you to obtain written representation regarding completeness of litigations and claims. It is mandatory for you to obtain written representation in that matter. Similarly, in SA 570, they will ask you to obtain written representation regarding going concern. It is mandatory for you to obtain written representation regarding the going concern. So 3 cases mandatory. What are the 3 cases mandatory? Management fulfill the responsibility for preparation of financial statements. Number 2, completeness of information provided to the auditor. Number 3, wherever there is a requirement of relevant standard, rest of the matter is auditor's choice. Rest of the matter, if auditor feels it necessary, he will obtain the written representation. Next, what should be the date and period covered by written representation? The date of written representation should be on or before the date of audit evidence. It can never be later than the date, sorry, on or before the auditor's report. I told audit evidence, no, sorry. So the date of written representation should be on or before the date of auditor's report, but in any case it should not be later. Why? Why? Because written representation is also a kind of audit evidence, and the sequence is first audit evidence, then auditor's report. If you take the audit report first and then dated the audit evidence, once again you are showing that you are a fool, which we should not look like, even though we are in some cases. Right. So this is what regarding date and period covered by written representation. Then, sir, from whom you will request written representation? Management. But management is a very broader term. Many people will get included there. All the team of board of directors will get included in the management. But we can't go and ask written representation from everybody, no. We generally go and ask written representation from that part of the management who are having the responsibilities relating to financial statements. Like if there is a CEO, we can go and ask the written representation from CEO. Or if there is a CFO, we can go and ask the written representation from CFO. If there is an audit committee, we can go and ask the written representation from audit committee. So we should go to that part of the management who are directly or indirectly associated with financial statements. Sometimes what will happen is we will ask a written representation regarding certain matter. Like say for example, SA 501, I need written representation regarding litigations and claims. I went to the management, I went to the CFO and told, sir, I need written representation regarding litigations and claims. CFO told, no, sir, I'm not the person looking into legal matters. We have an internal legal team. They are looking into the legal matters. Saying that, can he escape? Can he say, no, no, I don't have information. I will not give written representation? Can he say that? No. Then what should be done? So he should go to the concerned person in the organization, get the information from that concerned person, then provide the written representation to auditor. No person can escape saying, I don't have information, I am not getting associated there, I will not give written representation. He can't say it. So he has to go to the concerned person, get the required information, then provide written representation to auditor. Clear? Able to understand? Next. Like this also they have asked. In one exam they have asked, so auditor needs to auditor will ask representation from the management. Sometimes management will not have requested information. They will go to the concerned persons in the organization, get the required information and give the written representation to the auditor. Who are that concerned persons with whom management will go and inquire? Examples. Who could be that persons in the organization with whom management will go and consult? Like they have given examples like actuary. You are asking a written representation regarding provision, but management did not create it. Actuary has created it. Then what management should do? Go to the actuary, get the information, and then provide written representation to auditor. Similarly, legal expert, like as I've told, litigations and claims, and also staff engineer. When I'm asking something relating to the plant and machinery or some assets, then also what they can do, they can go to the concerned staff engineer, get the information, and then provide written representation to auditor. Next, when to obtain written representation from management to reconfirm its responsibilities. See, generally what I will do is at the beginning of the audit, at the beginning of the audit only, from the management, I will take written representation regarding two important things. No, what are they? That the management will fulfill their responsibilities regarding preparation of financial statements and completeness of information provided to auditor. At the beginning, I will get that written representation. But sometime during the course of the audit, I need to get once again written representation from the management to reconfirm their responsibilities. I got written representation at the beginning. They have confirmed their responsibilities. But in some cases, during the course of the audit, I need to get a confirmation once again that they are reconfirming their responsibilities. When? Number one, those who signed the engagement letter have changed. Initially, when you have accepted the audit, there were separate people who have signed the engagement letter. Now different people are there. Might be management has undergone some changes. Or terms of engagement are prepared in the previous year. Basically, last year you have got the written representation. When in the current year, see, some matters you need not obtain written representation year after year. You can use the last year's written representation also. But in case if the terms of the engagement have changed, then what we will do in the current year, we will get once again written representation. Or management misunderstands its responsibilities. Initially, when I asked for confirmation, management gave written representation, but they were confused. They did not understand it properly, and they gave the confirmation. I got to know about it. Let us sort out the misunderstanding by getting once again a written representation, and also if there are any changes in the circumstances. So these are the cases where the auditor will try to get written representation once again from the management to reconfirm their responsibilities. Next one. Sometimes you will get the written representation. You will ask the written representation. Management has given you that written representation also, but you have a doubt that those written representations are not reliable. When you will generally have a doubt that written representations are not reliable, when you have a doubt regarding their integrity, when you came to know that they are not honest people, or when you came to know that they are not having competence, they don't know what is exactly happening in the organization, but still they have given written representation, or you came to know that they don't have ethical requirements, they don't follow ethics and all, they're all fraudulent people, then generally you should get a doubt that whatever written representations you have got, they are not reliable. And also you should get a doubt that written representations are not reliable when they are inconsistent with other evidences. I told written representation is just a supporting evidence. So you would try to generally match that evidences with written representation. Sometimes they might be mismatch. I got evidence something else, management is confirming something else. Then what I should do? Then what I should do is I should try to resolve it. Where is wrong? Is my evidence wrong, or management is only giving written representation? If I decided that, okay, my evidence is only wrong, I will perform extra procedures and get the correct evidence. If I came to know that written representation itself is wrong, management has given written representation itself as wrong, is that a small issue or big issue? Very big issue. Management knowingly they have provided you wrong information. Now they say that in those cases you should take extreme action. You can even go and give a disclaimer of opinion. What you can give? Disclaimer. Why disclaimer? If the management has given the written representation itself wrong, what is the guarantee? Whatever information they have provided you, whatever financial statements they have given to you, to what extent they are genuine? Do you have any clarity? No. So that's why it is completely a deadlock situation. So what they have told us, in those cases, you can even go to an extreme and give a disclaimer of opinion. Next. Sometimes management will not give written representations only. I'm asking for written representation, sir. I want some matters for you to confirm. Please confirm. But the management is not at all giving written representation. Previous paragraph, I asked for written representation. They have given it, but those are not reliable. But now what? I asked for written representation. They are not at all giving that written representations only. Then what I should do? First, I should go and discuss. Be a gentleman once again. Go and discuss with the management. Sir, why are you not giving me written representation? Then if they give it, well and good, fine. If they are not giving, even after discussion also, they are not giving the written representation, then what we should do is re-evaluate the integrity of the management. Once again, now you got to know about the true nature of the management. Earlier, when you initially did the risk assessment, you thought that management are honest, but now you have realized that the management are not honest. Here also you need to consider modifying the opinion. Here also what you can do is go to an extreme and give a disclaimer of opinion. Why? Because management themselves are honest. To what extent I can rely whatever information they have provided to me till now. Understood? Comfortable, everyone? So this is what regarding SA 580. So we have completed SA 580 also. Now we will do one more thing. SA 510 we will try to cover. After that we'll go for a break. Right. So let us try to do SA 510, which is talking about initial audit engagement and opening balances. Before we go deeper, what does the standard say? First, let us become familiar with what is the meaning of initial audit engagement, what is the meaning of opening balances. The initial audit engagement I have already told. Initial audit engagement I have already told. If the previous year auditor and current year auditor are different, if the current year auditor is different from previous year's auditor, then the current year engagement will become initial audit engagement. This in simple terms. But how they have defined this term initial audit engagement in SA 510 is the engagement in which either prior years were unaudited, last year is not at all audited, or prior years were audited but by a predecessor auditor, someone else, not your firm. Someone else has conducted the audit of the previous year. Then also in the current year it will become initial audit engagement. So either prior years were unaudited, or the current year auditor is different, or the prior year is audited by predecessor auditor. Then what is the meaning of opening balances? You all know it, no? What is the meaning of opening balances? Those balances which are there at the beginning of the year. Those are nothing but last year's closing balances. And when I say balances, once again you will look at only balance sheet. But when I say opening balances, it even includes the disclosures also. Might be in the last year's balance sheet, in the last year's notes to account, they have told there is a contingent liability. Even that will also become an opening balance. So when I say opening balance, don't restrict yourself to balance sheet. Even in notes to accounts also, whatever things are there, they might also fall under opening balances. Then what is the auditor's responsibility? And one more thing before that, we say opening balances reflect two things. Opening balances reflect two things. What information is reflected in the opening balances? Number one, opening balances reflect the effect of all the transactions whatever have taken place in the preceding financial year. And also opening balances reflect accounting policies which are followed in the previous financial year. So opening balances reflect two kinds of information. So what will they reflect? Number one, they reflect the effect of all the transactions which have taken place in the previous year. They also reflect accounting policies which have been followed in the previous financial year. And when I say accounting policies, one fundamental accounting assumption should come to your mind: consistency. So by checking opening balances, you will get to know what accounting policies are followed in the previous year. Now you need to check whether the same accounting policies are applied in the current year. If they have changed, is there a proper disclosure there or not? So the same thing they will try to say there in the objectives also. What this standard is expecting from the auditor is they are expecting from you two things. Number one, obtain sufficient and appropriate audit evidence. whether opening balances contain a material misstatement that could affect the current period financial statements. Definitely, when the opening balances contain a misstatement, that is obviously going to come and affect my closing balances also. So that's why you need to obtain sufficient and appropriate audit evidence whether opening balances contain a misstatement that could affect my current period's financial statements. You need to obtain evidence regarding that. Sir, how I can obtain audit evidence? By performing audit procedure. Second objective, we will come to that later. First, let us complete the discussion regarding first objective. So you need to obtain audit evidence whether opening balances contain a misstatement that affect my current period financial statements. But in order to obtain sufficient and appropriate audit evidence, I know that I need to perform audit procedures. Sir, what audit procedures I have to perform to obtain audit evidence? That also they have told it in the question. That also they have told it in the standard itself. So what audit procedures they have told us? Read the most recent financial statements. Whatever most recent financial statements are there, that you have to read and determine whether prior period closing balances were correctly brought forward. Nothing but last year closing balances are matching with current year's opening balances or not. You have to check. Any adjustment relating to prior periods have been shown as prior period items. In the current year, if you find any error which belongs to a previous year, that you have to show it as a prior period item in the current year. So that you need to check. And also whether opening balances reflect application of appropriate accounting policies. Whatever accounting policies that are reflected in the opening balances, are they appropriate? Basically, whether correct accounting policies they have followed or not. And even you need to perform specific audit procedures like comparing the opening trial balance with the last year's audited financial statements. In addition to that, in the standard, you will be able to find something else. They specifically talk about what audit procedures you need to perform regarding current assets and liabilities, what audit procedures you need to perform regarding non-current assets and liabilities. That also they try to add it here. Just go through it once. Okay, so they don't go that deeper. Just if we understand this broader audit procedures, that will be enough. So this the later thing you can go, or once again, if you want me to quickly take you through it, I will take you through it. So when it comes to current assets and liabilities, what you should do? So in the case of inventories, if you just the current period's audit procedures on the closing inventory balances provide little audit evidence regarding inventory on hand at the beginning. See, in the current year, you will do closing balances verification, closing inventory verification you will do. That will provide very little evidence regarding opening balances. So when you are doing physical verification for closing balance, you get evidence regarding current year. From that, you will not get any evidence regarding opening balances. Therefore, additional audit procedures may be necessary. That's why in order to obtain evidence regarding opening balance of inventory, you need to perform additional procedures in addition to current year's inventory. So what I need to perform? Number one, observe a current physical inventory counting and reconciling it with inventory quantities. Nothing but if you are satisfied with the current year's closing stock, if you could do reverse calculation, same like we have done in the SA 501, if you are satisfied, if you are satisfied with current year's closing stock, you have to do reverse calculation and find out opening balance. That opening balance should match with my last year's closing balances. That you can do. Or you can perform audit procedures on the valuation of the opening inventory item. Nothing but ask the management to share the last year's valuation sheet. Try to perform audit procedures whether they have done the valuation properly or not. And also performing audit procedures on gross profit and cutoff, basically analytical procedures. These are nothing but analytical procedures you need to perform. Gross profit margins and all you have to compare. So this is what specifically you need to do regarding current assets and liabilities. And for non-current assets and liabilities, what you should do is like property, plant and equipment, investments, long-term debt. So you can obtain audit evidence by verifying accounting records and other information. Like for example, if PPE is there, management is saying this PPE is there in the as a part of opening balance also. What you can do is you can ask the management to share the copy of the ownership deed. In the ownership deed, I will see when is the date of the purchase. So that will give me evidence whether this is only belonging to current year or this belongs to previous year also. Next, in certain cases, the auditor may be able to obtain some evidence regarding opening balances through confirmation with third parties. Even external confirmations also you can use. So whatever it is, you perform audit procedures. These are general audit procedures, and we have seen specific audit procedures for current assets and liabilities, specific audit procedures for non-current assets and liabilities. So perform all these audit procedures and obtain audit evidence that opening balances do not contain any material misstatement. Okay, now after performing that audit procedures, what will happen? You came to know that opening balances do not contain any kind of material misstatement. What you will do? Unmodified opinion you will give. On the other hand, if you obtain sufficient and appropriate audit evidence that opening balances contain a material misstatement. You performed all the audit procedures, whatever we have told you till now, and you concluded that opening balances contain a material misstatement. Then what you will do? Then you have to modify. Which modification? Either a qualified or adverse. If it is only material but not pervasive, qualified. If it is material and also pervasive, adverse. What will be the other case? You already know. You are unable to obtain sufficient and appropriate audit evidence to determine whether opening balances contain a material misstatement or not. Then what you should do? Either you should give a qualified opinion or disclaim, depending on whether the possible effect is being material or material and pervasive. Understood? Next. So one objective only we are done. Till now what we have done? One objective. But I told there are two objectives. What is the second objective? As I have told, opening balances are reflecting accounting policies. But regarding accounting policy, we have a fundamental accounting principle, which is consistency. So they say you need to obtain sufficient and appropriate audit evidence whether accounting policies which are reflected in the opening balances, they have been consistently applied in the current year. Or if at all they have changed, that change has been properly disclosed or not. If there is a valid reason, you can change the accounting policy, but you have to give a proper disclosure. What change you have made, because of what is the effect, sometimes retrospective effect, sometimes prospective effect. All this you have learned in the accounting standards. That proper disclosure is required to be given. So I need to obtain sufficient and appropriate audit evidence. Without any valid reason, they should not change accounting policy. Point number one. If there is a valid reason, they can change it, but it should be appropriately disclosed. Now, how it will have an impact on opinion? Number one. So there could be two cases. Listen carefully. Management, if you have obtained sufficient and appropriate audit evidence, management, without any valid reason, they have changed the accounting policy. That means consistency has been violated. The management has changed the accounting policy without any valid reason. Or there is a valid reason. That's why management changed the accounting policy, but they did not give proper disclosure. Two cases. You have an audit evidence where without any valid reason, management changed the accounting policy. Or you have evidence that management has changed the accounting policy. There is a valid reason, but they did not appropriately disclose it. In both these cases, what you are supposed to do? Modified opinion you have to give. Which kind of modification? I told you have a evidence. What you will do? Either a qualified opinion or adverse opinion you are required to give. Here the standard did not say what if there is no audit evidence. For opening balances, they have told two cases. You have evidence, you don't have evidence. But for accounting policies, they talked about only one scenario. What is that? If you have evidence, then you give either qualified or adverse. They did not say about no evidence. See, in accounting policies, you cannot say I don't have evidence. You are an expert. No. What are you? Expert. Expert in what? Accounts and audit. You can't go and say I am unable to decide whether the accounting policy is consistently applied or not. I am unable to decide whether the disclosure has been given or not. Can you say that? If you say that, will that be a shame on you or not? If I say keeps it in the material, if it is more shame or not? So that's why they did not give that scenario. So when it comes to accounting policies, only one scenario. You will have evidence. You must have the evidence. Then only you deserve to be a chartered accountant. So you will have evidence, you must have evidence whether accounting policies are consistently applied, or if there is any valid reason for change, whether it has been appropriately disclosed or not. So then you will give qualified or adverse. Then one more last paragraph. Sir, I am doing the audit for the current year. Last year auditor has given a modified opinion. Is there a mandatory obligation on the current year auditor to also give the modified opinion? If such mandatory obligation is there, once the company gets a modified opinion, never back in its life, they will get again a unmodified opinion. So it is not the case. Just because last year's auditor's report contains a modified opinion, the current year auditor need not always give a modified opinion. He will give modified opinion in the current year only when that matter still remains relevant and material for the current year, and it is not rectified in the current year. Then only he will express what? Modified opinion. If because of whatever reason last year auditor gave modified opinion, that is no longer relevant for the current year, that is no longer material for the current year, if it has been rectified in the current year, then there is no need for giving modified opinion. You can give unmodified opinion. Understood? That's all. This is what regarding SA 510. How many standards we have covered? 4 we have covered. 501, 505, 580, 510 we have. How many more we have under 500 series? 550 we have, 560 we have, 570 we have, 5, that only 580 we have covered. 3 we have. 520, 530 we will have a separate discussion. Okay. With that 500 series will get over. Then we have 200 series. 260, 265. That we will try to cover. After that we have 450. Evaluation of misstatements. That is getting asked very frequently in the recent because it was a newly added content. So then we will do 260, 265. After that, that 450 also we will do evaluation of identified misstatements we will do. Then after that, SQC1, SA 220. SQC1 and SA 220 also we will do. Then apart from that, SA 620 we will do. Quickly SA 620 using the work of internal auditors we will do. Sorry. 610 using the work of internal auditor we will do quickly. 720 I will not explain. 720 I will not do is that standard is not at all fit for revision, but still on my YouTube channel you will be able to find a detailed video with the charts. I have chat and the detailed explanation of that. Sorry. Yesterday I worked on 620 and 720 for CFN, so that thing is only coming on my mind. So 7 comparative information and all that standard is there. So that for that I have a chart. Detailed explanation has also been there. A video we will be able to find in the YouTube that you can watch. Perfect clarity you will get. I know SS710 is troubling for many, but just to watch that video, your perspective will change regarding SS710. Such an easy standard it is. So just go and watch that video. After that, I will wind up standards. We will wind up the standards and we'll see after that what we will do. Okay. We will do. Now, if I start asking your opinions, everybody will say one chapter. So it becomes quite difficult. We will see, depending on the availability of the time and all. We will try to cover. I think I can easily cover audit in an automated environment, audit sampling, analytical procedures. These 3 chapters, just like that, I can complete it. After that, also, if the time is left, we will see. Okay. Strategy planning and program also we will do. There also questions are getting tested. We will do definitely strategy planning and program also we will do. Till now we have completed 4 500 series of the standards. What are they? What and all we have done? 500 we are done. 501 we are done. 505, 510, 580. Yeah. So these 4 standards we have completed. Let us now try to proceed further and understand few more 500 series of the standards. Volume reduce. Okay. They are doing it. Okay. So first what we will do, we'll take one simple standard, say 550, we will try to understand, which is increase. Fine enough? Okay. So now we will try to understand SA 550, which is going to talk about related parties. So as we all are aware, wherever we have a related party transaction, there the risk of happening of material misstatement is very, very high. And also, if you remember, when we discussed the inherent limitation concept, there we have seen one of the main reason for inherent limitation is related party transaction. So that's why wherever related party transactions are there, since there is a huge scope for manipulation, that's why accounting standards also have a lot of disclosure requirements. So many disclosure requirements are there regarding related party transactions, even as per accounting standards. Similarly, from auditing perspective also, since related party transactions have a high chances of misstatement, they have given us a dedicated standard. It exclusively gives us a guidance what audit procedures you need to perform, what evidence you are required to obtain regarding related party transactions. But before that, we need to understand what is the definition of related party. Now, here the standard has played it very safe. They have told that in the applicable financial reporting framework, if the related party has already been defined, follow that definition. Like for example, if you take companies, in case of companies, applicable financial reporting framework is Schedule 3 and accounting standards. In case in that applicable financial reporting framework, if the related party term is already defined, follow the same definition. Whatever definition they have given under applicable financial reporting framework, whoever they told will fall under related party definition. So just follow the same definition. In case applicable financial reporting framework does not define the term related party, then follow the definition whatever we are giving in the standard. If applicable financial reporting framework defines, follow the definition. In case if the applicable financial reporting framework doesn't define the term related party, then in SA 550 they have given the definition. That definition you are supposed to follow. Sir, as per the definition of SA 550, when 2 parties will be considered as related? So they say that 2 entities will be considered as related if they have control or significant influence over entity. if a person is having control over another entity or influence over another entity. So that then both will become related parties. Or another entity over which reporting entity has significant control or influence. You are controlling someone or someone is controlling you. You are having significant influence on someone or someone is having a significant influence on you, related parties. And they say one more thing also, another entity that is under common control with the reporting entity, either through common ownership, owners who are close family members, or common key management. Basically you and some other entity, your client entity and some other entity, both are under common ownership. A third party is controlling both. So then these two entities which are under common control, they will also become related, and that common control can be by way of common ownership, or the owners can be close family members, and even they could be a common key management. So someone is having, if someone is having influence over your client, related party. Your client is having influence or control on other, related party. Your client and some other entity both are under common control of some third party, then that entity which is with common ownership under you, common control under you, so that also will become a related party. Clear? Next. And here there is one exception. They have given an exception regarding government entities, state related entities. So they say that entities which are under common control by a state, even though they are under common control, they will not be considered related unless they engage in significant transactions or share resources. So I told that which are under common control, if two entities are under common control, they will be considered as related. One exception to that rule. If two entities are under common control of a state, state in the sense government they are talking here. If two entities are under common control of a state, they will not be considered related unless they share resources or unless they engage in significant transactions. So this is how the term related party has been defined. Then talking about the nature of the related party transactions. See, related party transactions, if they are happening like a normal transaction, under whatever terms and conditions normal transactions happen, under the same terms and conditions, if the related party transactions are also happening, be it price, be it payment terms, be it delivery terms, whatever it is. So if the related party transaction is also happening at par with a normal transaction, then there will be no high risk of material misstatement. Then they will be having low risk only. When they are equal, when they are equal in all terms. So if the related party transactions are in the normal course of business, then there might be no higher risk of material misstatement. But however, in some cases, the risk is very, very high. In some cases, related party transactions carry a very high amount of risk. In what kind of circumstances? Number one, if they operate through extensive and complex relationship. There is existing on related party through with which you don't have any direct relationship, but the relationship is very complex. So what do you mean by indirect relationship or complex relationship is, say for example, there is one company. It has created one subsidiary. That subsidiary created one associate. That associate is having some joint venture. In that joint venture, one director is there. That director has incorporated another company. So a very distant change is there. Very complex relationship is there. In these kind of cases, it becomes difficult for you to identify whether that entity is a related party itself or not. So whenever the related parties are operating through a extensive or complex relationships, it becomes very difficult, that the risk of material misstatement is very, very high. On the other hand, if the relationship with the related parties is straightforward, like direct subsidiary company, direct associate company, direct joint venture, then it is low risk. But if it is a complex or extensive relationship, then there is high risk. Similarly, information system may be ineffective. Whatever information system, basically today, so many related party transactions will be there. And if you open the financial statements of any company, related party transaction, so many pages of disclosures will be there. 2-3 pages will be dedicated only for explaining related party relationships and related party transactions. Today, the human beings are not accumulating all the related party transactions. The accounting software itself will identify the related party. That accounting software itself will accumulate related party transactions. That software will itself give a report. So now what we need to check is whatever that software they are using, whatever accounting software they are using, is it effective or not? Why? Because if the accounting software is effective, if the accounting software has been designed properly, yes, related party disclosures will be given appropriately. On the other hand, if the client is using some useless information system, if it is not able to identify or accumulate all the related party transactions, and if the company starts relying on such a software, the system will give wrong reports. That reports only they will include in the financial statements. In those cases, financial statements are having a chance of misstatement or not. Yes, that the risk is very high. Similarly, when the related party transactions are not conducted under normal market terms and conditions, like pricing is different, you are showing some favorism to your related parties, there the risk of material misstatement becomes very high. So summary of this paragraph is, generally if the related party transactions are happening under normal market terms and conditions in the normal course of business, they might not carry higher risk, but in some cases there will be a very high risk of material misstatement with regard to related party transactions. Three cases they have given where there will be high risk of material misstatement. What are they? When they operate through extensive and complex relationships, information systems may be ineffective, and they are not operating under normal market terms and conditions. Next. So what will be the responsibilities of an auditor? As an auditor, if you came to know that your client is having related party relationships or related party transactions, as an auditor, what responsibilities you are required to fulfill? Number one, first you have to obtain audit evidence regarding accounting and disclosure requirements. Basically, as I have told, even if you take Schedule 3, even if you take accounting standards, there are so many disclosure requirements they have mentioned. So as an auditor, my objective is to obtain sufficient and appropriate audit evidence, whatever accounting and disclosure requirements are given under accounting standards, under applicable financial reporting framework, whether all that accounting and disclosure requirements are fulfilled or not. So what I have to do as an auditor, what is my responsibility? Whatever accounting and disclosure requirements are there given under applicable financial reporting framework, whether the related party transactions are accounted as per that, whether all the disclosures are given as per the applicable financial reporting framework. Now, as we all are aware, if we want to obtain evidence, what we should do? You should perform audit procedures. So to obtain that audit evidence, what audit procedures I have to perform? That they are mentioning in the standard itself. So as an auditor, you should perform audit procedures like you have to obtain an understanding of accounting and disclosure requirements. Common sense, no? Before you can see whether accounting and disclosure requirements are met or not, first you should know what are the accounting and disclosure requirements. So first you should go through the applicable financial reporting framework, and first you understand what are accounting requirements, what are disclosure requirements. Then to obtain understanding of related party relationships and transactions, now go and sit with the management, ask them, give me a list of all the related parties, give me a list of all the transactions you have done with the related parties. Then to conclude whether financial statements give a true and fair view and are not misleading, especially because of related party transactions. So you need to perform audit procedures. Which audit procedures you have to perform? First, obtain an understanding of accounting and disclosure requirements. Number two, obtain an understanding of related party relationships and transactions. Number three, finally obtain an understanding whether financial statements are giving true and fair view and they are not misleading, especially because of related party transactions. Next. See, because of related party, the chances of happening of fraud are also very high. And once again, if you apply the practicality here, many frauds, whatever have taken place in the recent times, in every fraud, you will be able to find the related parties. They commit this fraud through shell companies. They incorporate this subsidiaries, associates, like shell companies, we call them. Just for namesake, they incorporate the companies, and they incorporate these companies in the tax havens, in the Mauritius or in that British Islands, like that. So we have so many these kind of things are there. Tax havens are there. There they will incorporate some related parties, and through the related parties, many of the scam funds will go out of India. So related party transactions can lead to high chances of happening of fraud. So that's why you need to pay close attention to the related party transactions to identify whether there is any fraud getting committed. Misstatement, that too because of fraud. The chances are very high. So you need to pay close attention. Then, as we have already seen, because of related party transactions, there is a chance of inherent limitation. One of the main inherent limitation is arising because of related party transactions. So in case of related parties, the significance of inherent limitations are very much higher. Because of related party transactions, the chances of auditor's opinion going wrong are much high. So that's why what you should do is management may be, why? Because management may become unaware of existence of related party transactions. Sometimes management itself will not know who is a related party, who is not a related party. And also related party transactions provide a greater opportunity for collusion and manipulation. So that's why the inherent limitations are very greater for related party transactions. Then you have to maintain professional skepticism. If you want to overcome all these problems, all these headaches, one thing what you can do is you have to maintain professional skepticism. You have to maintain that attitude of questioning mind. To some extent, you can reduce your risk. So when we talk about auditors' responsibilities, they have told four things. Number one, you need to obtain audit evidence regarding accounting and disclosure requirements. To do that, first you should obtain understanding of accounting and disclosure requirements. You should obtain understanding of related party relationships and transactions, and also you should make sure that financial statements give a true and fair view and are not misleading. Number two, you should pay close attention for identification of any fraud, because fraud risk factors will be there. Number three, because of related party transactions, the inherent limitations are very higher. Because sometimes management themselves are not aware who is a related party, and also related party transactions provide greater opportunity for collusion. And then finally, last one, you have to maintain professional skepticism. If you have to overcome these problems, you have to maintain professional skepticism. And also we have one more last thing, how auditor can verify existence of related parties. If you want to know whether your client is having related parties or not, what you should do? First, you should go and ask the management. You will go and ask the management, sir, please tell us who and all are your related parties. You will do inquiry. But in case of inquiries, I have already told you, inquiry will give least evidence. If you go and ask to the management, sir, I want you to give me a list of all the related parties, they will give. But you should not blindly believe on that. You should also verify some documents from your side to know whether related parties are there or not, or management has hidden some related parties from you. You will definitely go and ask. Management will give a list, but you don't blindly rely on it. You also try to verify some documents from your side to identify the related parties. So what documents I have to verify, sir, to know whether there is any existence of related parties? Number one, you can go through income tax returns. There also they will report related party transactions, and also information provided to regulatory authorities. Like in case of MCA, company filings and all, you are required to file the details of related parties. You can go through that filings also. Shareholders register. If you go to shareholders register, you will come to know who is your holding company, who is your associate entity, that you will get to know. Then statement of conflict. Basically, statement of conflict is a thing under Companies Act where they say if you are a part of the management and if your company is going to take decision in which in the transaction you are having interest. Like for example, there is a person, Mr. A. Now this person A is a director in the company ABC Limited. This ABC Limited wants to purchase goods from a firm XYZ and Co. A firm is there. From that firm they want to purchase the goods. But in that firm, one of the partner is Mr. A once again. So this company is doing a transaction with another entity, but in this transaction, one of the director is having a interest. So when they are doing that decision making, they should stay away from that decision making. Here in this transaction, Mr. A should stay away. Why? Because he is having a interest there. And he should submit something called conflict of interest to the management. And listed companies and all, it will happen. So they have to submit a statement of conflict. They will say, boss, the company or the entity with which you are doing the transaction, in that I am having a interest. So like that, they will submit a statement of conflict. Now, one simple logic, if I can go through that statement of conflict, I can easily understand who is a related party, who is not a related party. And also I can go through investment register. If you go through investment register, once again, you will get to know subsidiary companies, associate companies, joint ventures, that you will get to know. Contract and agreements with the management. So nothing but with the key management, what and all contracts you have entered, go through that contracts and agreements. And contracts which are not in the ordinary course of business. If you find any contract which is beyond the normal course of business, try to dig deeper. Why? Because outside the normal course of business, the companies do transactions only with the related parties in 99% of the cases. And then even you can go through internal auditors report. So definitely will inquire for related parties, but don't just stop with inquiry. You verify the documents, you verify these documents from your side, so that you might find the existence of a related party. Understood? That's all. We have completed Sep' 550. Related party discussion, we are done. So now what we will try to do is we will pick the next most important standard, 570. We will pick now. What? Go. Oh, title you are telling, fine. Okay, so we will try to cover now SA 570, talking about going concern, one of the most important standard from the examination perspective. Conceptually also it is very important. So let us try to understand SA 570, which is talking about going concern. Is going concern an important matter? Is going concern is important in the preparation of financial statements? And even if you are aware, they say going concern is a fundamental accounting assumption. What is it? Fundamental accounting assumption. What do you mean by going concern? First of all, the entity will continue for the foreseeable future. Foreseeable future means how long? 1 year. For the coming 1 year, entity will continue. Neither it is having a intention to liquidate, nor there is any pressure on them to liquidate. So just having an intention alone will not be enough. If the management says, yes, we have an intention to continue in the coming 1 year, will going concern be valid? No, situations also should permit them. Their financial position should permit them. Sure, their operations should permit them. So there is no intention and also there is no requirement for the entity to close down in the foreseeable future. That assumption, we call it as going concern assumption. Now, so what role going concern assumption plays? How it is going to have an impact on the financial statements? How it is going to have an impact on the financial statements is, see, when I prepare the balance sheet, when the management prepares the balance sheet, as on the date of the balance sheet, they have to make one decision whether going concern is valid or not. They have to make an assessment and determine it. If they feel that going concern assumption is appropriate, that means entity will continue for the foreseeable future. Then they will prepare the financial statements on that basis. On going concern basis, they will prepare financial statements. So what do you mean by preparation of financial statements on going concern basis? So basically what they will try to do is fixed assets they will value at the historical cost. So current assets they will value at the realizable values and all. So historical cost we follow for fixed assets, mainly fixed assets. That is where the impact is going to come. So mainly fixed assets will be valued at historical cost. That means whatever you have acquired it at a long ago, so at that price we will value it. Why? Because fixed assets we are not holding with the intention of selling. So we are holding it for the purpose of using it for our business. So that is what the meaning of going concern basis. So when we are preparing the financial statements on going concern basis, we continue to value our fixed assets at historical cost because we don't have any intention of selling them. In case if the going concern assumption is invalid, if the going concern assumption is invalid, what do you mean by going concern becoming invalid? The entity will not continue for the foreseeable future. Either the management wants to liquidate or the situations doesn't permit the entity to continue for the foreseeable future. Then the company can no longer value their fixed assets at historical cost. Because if entity will not continue for the foreseeable future, even fixed assets are held with the intention of selling. So in that case, we prepare financial statements on something called liquidation basis, we say. What do we say? Liquidation basis. That means all the assets, all the liabilities, we will determine if the company sells them as on the balance sheet date, how much they will be able to realize. That value they will determine. All the assets, all the liabilities will be shown at realizable value. And the difference between that book value and the realizable value, that will go and give the impact to the statement of P&L. So you tell me, going concern is having a significant impact on the financial statements? Very bigger impact on the financial statements it is going to have. And in case if the management tries to tamper with the going concern assumption, the management tries to do wrong things regarding going concern assumption, will it be a misstatement in the financial statements? Yes. Will it be a material misstatement? Will it be a pervasive misstatement? 100% yes. Why? Because going concern is something which is fundamental to users' understanding of the financial statements. Okay, so till now we understood the importance of going concern assumption from the accounting perspective. Now, as we all are aware, standards on audit doesn't talk about financial statements. Standards on audit talk about auditing requirements. So now, as an auditor, what is your responsibility? As an auditor, what is your responsibility? First of all, who will make an assessment regarding going concern? So whether we will continue for the coming 1 year or we will not continue for the coming 1 year, whether going concern assumption is valid or invalid, who will do that assessment? It is always and always the responsibility of the management to do the assessment. On what basis they will do the assessment? Will they toss a coin? Heads comes going concern valid, tails comes going concern invalid. No. So they will consider some factors. So what factors they will consider? They will consider the factors like size and complexity of the entity. What is the size of the entity? What is the complexity of the business they are doing? And also they focus on nature and condition of the business. What is the current nature of the business? What is the current condition of the business? They will pay attention. Uncertainty of events and conditions. Like for example, any legal cases going on them, any significant changes in the laws and regulations are going to come. So they will even pay attention to events, uncertain events like pending cases, laws and regulations. And even they will consider the effect of external factors. Once again, this laws and regulations kind of thing. So they will pay attention to various factors. These all factors they will consider, and then they will make an assessment whether going concern assumption is valid for them or going concern assumption is invalid for them. Now, what is auditor's responsibility? Till now we have seen management responsibility. What is auditor's responsibility? To obtain sufficient and appropriate audit evidence whether whatever management has done the assessment regarding going concern, is it valid or not? Is it appropriate or not? whatever assessment management has done regarding going concern, whether that assessment of going concern done by the management is appropriate or not, that we need to obtain sufficient and appropriate audit evidence. Like if the management says, yes, our going concern assumption is valid, we will continue for the foreseeable future. They are preparing the financial statements on going concern basis. They are continuing to value the fixed assets on historical cost. Now I need to obtain audit evidence. Is it so? Really the entity will continue for the foreseeable future, or there is any requirement on the company to close down in the coming 1 year? That appropriateness, regarding that appropriateness, I need to obtain sufficient and appropriate audit evidence. So obtaining audit evidence is my responsibility. I will come back to this remaining two responsibilities later. I will come back to this two responsibilities later. So now, okay, so your objective is to obtain what? Sufficient and appropriate audit evidence. Now, to obtain that sufficient and appropriate audit evidence, you need to perform audit procedures. So what audit procedures and all you will perform, we will talk about it later. But after performing all the audit procedures, what audit procedures we will do, we will discuss it. But after performing all the audit procedures, he will be left with some observations. He will have his findings. Now let us try to understand what impact that findings will have on his opinion. What impact that findings will have on his opinion. So I will do some different this chart only. This is a since it is getting very clumsy, I have divided the chart into multiple parts. But if I draw one single chart covering all, so after he has done all the audit procedures, there might be multiple cases. Let us try to understand each case. Number one, you performed audit procedures, you obtained assumptions, you obtained audit evidences, and you have concluded that the management going concern assumption, whatever management has decided, that is appropriate. Or let me put it this way, going concern assumption is valid. Entity will continue for the foreseeable future. There is no doubt, there is no intention also, there is no requirement also to close down the business. Entity will definitely continue for coming 1 year. You have perfect evidence. Very good. Management has also prepared the financial statements on going concern basis. Now what you will do? Management has also prepared the financial statements on going concern basis. What you will do? You will give unmodified opinion. So basically we will give what? Unmodified opinion we will give. No issue to modify the opinion. Next. Let us come to the other case. What could be the other cases? You might decide that going concern is invalid. You came to know going concern is invalid. That means entity will not continue for the foreseeable future. Then what we should do? So then we should decide whether there is a adequate disclosure in the financial statements. In case if you came to know that going concern is invalid, we need to check, is there a adequate disclosure? So what do you mean by adequate disclosure? What do you mean by adequate disclosure? So adequate disclosure in the sense that the company has realized that fact that going concern assumption is invalid and have prepared the financial statements on liquidation basis, and the differential component they have taken into the statement of P&L. So everything they have valued at realizable value, difference also they have taken to the statement of P&L. In the notes to account also clearly they have explained that they will not continue for the coming 1 year. What opinion I will give here? Unmodified opinion I have to give. Why? Because I will give modified opinion only when there is a material misstatement. But here people are genuine, no. So they did not hide anything. Yes, they also agreed. Yes, sir, we will not continue for the coming 1 year. They agreed to that fact. They have valued all their assets and liabilities at realizable value. Differential also they have taken to statement of P&L. Even in the notes to accounts also they have clearly explained that they will not continue for the foreseeable future. So no mistake they have done. So here there is no purpose in giving a modified opinion. What I can do here? Unmodified opinion I will give. What if there is no adequate disclosure? What if there is no adequate disclosure? What do you mean by not giving an adequate disclosure? Even though I got to know, even though I have a clear evidence that entity will not continue for the coming 1 year, but management is denying the fact and they continue to prepare the financial statements on going concern basis only. That means they are still continuing to value their fixed assets on historical cost basis only. Now what I should do? Now you have to modify. Which kind of modification? So you have to directly give a adverse opinion. Directly give adverse opinion you are supposed to give. Okay, why adverse? So as we have told at the beginning, if the management tries to tamper with the going concern assumption, definitely that will lead to a misstatement. That misstatement will not just be material, it will be pervasive also. And you have a evidence that going concern is invalid also. So you are supposed to give adverse opinion. Understood till here? Next. Let us come to one more case. So what is the one more cases? You performed audit procedures. You came to know that going concern looks valid only, but there is some material uncertainty relating to going concern. For the time being now, going concern looks valid, but there is some material uncertainty relating to going concern. There is some uncertainty, there is some doubt. That means whether entity will continue in the future or not, some doubt is there. For the time being now looks good, but it is depending on some events. If I put it in this way, it depending on some events whether entity will continue in the future or not. That is going to depend on some events that is even beyond the control of the auditor, beyond the control of the management. So if I have to give you one example, your client company is going through some pending case. Your client company is going through some pending case. The person, whoever has filed the case, he is demanding a very huge amount of money. As on the balance sheet date, the proceedings are still going on. If that case materializes, just in case, if that case materializes, and if the person who has filed the case, he wins the case and company loses the case, the penalty amount or the consequences which the company has to face are so huge that the entity will not be able to continue. The entity will not be able to continue if the company loses the case. Able to understand? I'm not telling company will definitely close down. What I'm saying, company might get closed down if it loses the case which is currently going on in the court. So here there is an uncertainty. Because of some circumstances, I'm unable to decide whether entity will continue in the future or not. I have a uncertainty. I performed audit procedures. I came to know there is a material uncertainty relating to going concern. That is depending on some events or conditions which are beyond the control of the management, beyond the control of the auditor and all. Now what you should do? Now what you should do? If you found material uncertainty relating to going concern, what you are supposed to do? So here also, if you found material uncertainty relating to going concern, you need to check whether there is a adequate disclosure or is there no adequate disclosure. If there is a adequate disclosure, what you will do? Had the management made any mistake? Are the financial statements misleading? Are the financial statements giving true and fair view there? Yes, 100% yes. So what opinion you will give? Here also I will give unmodified opinion. But see, management without their fault, they have already disclosed or presented an information in the financial statements. But don't you think this is very fundamental to users' understanding of the financial statements? The management without their fault, they have appropriately disclosed and presented this information in the financial statements. Don't you think, even though they have disclosed and presented it, it is a matter which is very fundamental to users' understanding of the financial statements? So, don't you think the auditor is having a need to highlight this somewhere in the auditor's report? What he can do? Not keyword. Emphasis of matter paragraph. The matter which is already presented or disclosed in the financial statements, but it is very fundamental to users' understanding of the financial statements, that is required to be highlighted in emphasis. You could have done it if the standard has not told anything specifically. The standard has not told anything specifically. As you said, what we would have done is we would have highlighted that in the emphasis of matter paragraph. What the standard specifically says here is you highlight it, but don't use emphasis of matter paragraph. You use a separate paragraph with a title material uncertainty relating to going concern. You highlight it. We don't have any objection. You highlight it. But don't use the emphasis of matter paragraph. You use a separate paragraph with a heading material uncertainty relating to going concern. With that heading, you use that paragraph, then highlight that matter. Understood? Clear and comfortable, everybody? Right. Next, what if there is no adequate disclosure? See, if you remember, we have covered all the contents of the SA700 except one content I did not explain there, material uncertainty relating to going concern. That content we have covered it here. All the contents of the audit report in SA700 we are done. One we did not cover, that is material uncertainty relating to going concern, which we told we will talk about in the SA570. Now we have covered that point also. With this, all the contents of the audit report we have covered. Now, if you come to the other case, if the management is not giving adequate disclosure, then what you should do? So then we have to give modified opinion. Which kind of modification? Which kind of modification? You have to give either a qualified opinion or you have to give a adverse opinion. Now multiple doubts will be there in the minds of the students. Now you will say, sir, since we are unable to determine whether going concern is valid or not, since we are having a material uncertainty, don't you think it is a case of non-availability of audit evidence? So we should have given a qualified or disclaimer of opinion, no, sir. Nobody got that doubt. We are telling material uncertainty relating to going concern. That means we are unable to decide going concern is valid or not. It is depending on some event. So you should have, it is a case of non-availability of audit evidence, no? Should have given qualified or disclaimer, right? No. Why no is we are modifying the opinion not because of material uncertainty. We are modifying the opinion not because of material uncertainty. We are modifying the opinion because the management did not disclose that material uncertainty regarding which we have evidence. See, if there is a material uncertainty, there is nothing wrong in that. We are not modifying our opinion because there is a material uncertainty. Why we are modifying our opinion? Management did not disclose that material uncertainty. For that I have evidence. No, I clearly know that management did not disclose that. So it is a case of evidence only. I have evidence that management did not disclose that material uncertainty in the financial statements. That's why I will give either qualified or adverse. Now one more doubt you should get. Sir, you told if the management tries to tamper with the going concern and all, it will always be material and pervasive. Directly, you should have told qualified. Directly, you should have given adverse. No, sir. Why once again you are bringing qualified here? Here also, what they say here is yes, if the management tries to do something regarding the going concern, it is definitely material and pervasive. But here, why they have told qualified and adverse is depending on severity of the material uncertainty, we have to decide it. Depending on what? Severity. Say, for example, same, the company is going through one pending case. I spoke with the lawyers of the team and all. I consulted some external lawyer also. Those lawyers are all telling that, sir, company will not lose the case. The company will definitely win the case. 100%, 99% it will win the case. Everybody is saying the company will win the case. There is a material uncertainty. Agreed. But the effect of that uncertainty is not so big. The chances of winning are much high. The chances of going concern becoming invalid are very, very less. So here what I can give? Just qualified opinion I can give. But however, same pending case is going on. The chances of winning or losing I have to decide. Whenever I spoke with anybody, they are saying, no, sir, there is a probability company might lose the case. So here the effect of material uncertainty is very, very bigger. The chances of going concern becoming invalid is very, very higher. Now what I will do? Now I will give adverse opinion. Understood? Clear and comfortable, everybody? So these and all are different outcomes which could be possible. And one more outcome also could be possible. What is that one more outcome is? Management is not sharing their assessment regarding going concern. As an auditor, I need to obtain audit evidence regarding going concern. Management will make an assessment. I will ask them to share the assessment. They will share the assessment. On the basis of that, I will decide whether going concern assumption is valid or not. But when I go to the management and ask, sir, please share your assessment. On what basis you have done the assessment regarding going concern? Please share with that to me. I will do the assessment. I will perform audit procedures and try to obtain audit evidence. Management is telling, no, we will not share that assessment with you. On what basis we have decided going concern is valid or invalid? We will not share that basis only with you. Now, what you will do? Since you are unable to obtain audit evidence, you have to modify your opinion here also, but here you have to give either qualified or disclaimer. But I do personally believe instead of qualified, disclaimer will be the best option. Directly have to give disclaimer, because if the management is not sharing assessment regarding going concern, so maybe here their intention could be majority of the information they have shared, just 1-2 points they did not share, then you can think of qualified. But if most of the information is not shared regarding assessment of going concern, then we give disclaimer of opinion. Understood? Clear? So these are all the different outcomes which could be possible and how they could have a impact on the auditor's opinion. Okay, shall we proceed further? Standard over? Not at over. So what we have discussed till now? First we have seen what is management responsibility. We are seeing auditor's responsibility, and that I have told only first point. To obtain sufficient and appropriate audit evidence regarding management's assessment of going concern. Second objective, on the basis of your audit procedures, you have to determine whether there is any material uncertainty relating to going concern. In case if you find any, you have to report as per the standard. How to report as per the standard, that's what we have seen till now in the chart. How to report it, we have seen. Able to understand? So three objectives of the auditor as per SA 570. What are the three objectives? To obtain sufficient and appropriate audit evidence regarding appropriateness of management's use of the going concern assumption. Number two, to determine whether there is a material uncertainty relating to going concern. Number three, to report in accordance with this essay. Okay, next. Okay, so as I was saying, you need to obtain audit evidence regarding appropriateness of management's use of going concern assumption. But to obtain audit evidence, we need to perform audit procedures. So what audit procedures I have to perform? Here also they say I need to perform audit procedures under two categories: risk assessment procedures, further audit procedures. So first, in risk assessment procedures, what we do? Oh, no. Risk assessment procedures, what is the outcome? Identify the risk of material misstatement. Like in SA 501, I have told litigations and claims. First, you need to identify whether there is any risk of material misstatement in that area. Here also SA 570 says first perform risk assessment procedures. First identify, is there any risk of material misstatement regarding going concern? But this they phrase it in a different manner. What they're expecting from you is identify whether there is any risk of material misstatement regarding going concern. But they phrase it in a different manner. So what do they say is the auditor shall consider whether any event or condition exists that may cast a significant doubt on entity's ability to continue as a going concern. Find out whether there is any event or whether there is any condition which is creating a doubt regarding entity's ability to continue as a going concern. More or less, if I put it in the other way around, what they are trying to say, find out whether there is any risk of material misstatement regarding going concern. That's what they're actually trying to say. Okay, clear and comfortable, everyone? Right. Next. Yeah. What else we have? How to identify? See, before I can say how to identify, I would like to say one more thing. Before I say how to identify that event, first we should know what are that events or conditions which create a doubt on going concern. Do you agree with me? See, the standard, they're saying by way of risk assessment procedures, they're asking me to identify whether there is any event or condition that may cast a doubt on entity's ability to continue as a going concern. But before that, I should know what are that events or conditions that create a doubt on going concern. Yes or no? So that we call them as indicators. So that standard itself has given. They did not ask you to go and search what events and conditions will cast a doubt regarding going concern. They told we will only say what kind of events and conditions which create a doubt regarding entity's ability to continue as a going concern. And those are divided into three categories. Those are divided into how many categories? Three categories. Those are financial indicators, operating indicators, other indicators. So a few examples of these indicators are also given here. Examples of the financial indicators: the company is having always a net liability position. Borrowings are approaching maturity, but they don't have any amount to repay that borrowings. Negative cash flows, continuously they are generating negative cash flows. Withdrawal of financial support, your creditors, bankers are withdrawing their financial support, or adverse financial ratios. Bad financial ratios they are having. Operating indicators like management itself is having an intention to liquidate. They don't want to continue any longer. Loss of key management. Key persons in the organization have left. Labor difficulties. The company is unable to find the labor who are ready to work for their factory. Shortage of supplies. Whatever raw material they want for the purpose of running their business, that raw material is in huge shortage. Or even successful competitor. All of a sudden a huge successful competitor has come and all your customer base has shifted. Or it could be even other indicators like non-compliances with the laws and regulations. Your client is not complying with laws and regulations. Pending cases, so many pending cases are there against your company. Uninsured catastrophes. Uninsured catastrophes. In the recent times, some catastrophe happened, some calamity happened, some earthquake happened, some fire accident happened, and luckily your client is not having an insurance policy. Right. So he will have to close. Then changes in laws and regulations. So these are all other indicators. Why I was talking about this? From where we have come to here, we are discussing risk assessment procedures. So what you should do is, first you should identify whether any of these events are present, whether any of this financial indicator, any of this operating indicator, or any of this other indicator is present or not. That we need to find it out. Sir, how can I find it out, sir? How can I find it out? Simply what they say here is by inquiring management. Don't do anything, just go and inquire with the management, sir, whether any of these indicators are present. Okay, so now by inquiring management, two outcomes could be possible. By inquiring management, two outcomes could be possible. What will be that two outcomes? There may be, yes, you have found out some events or conditions which create a doubt regarding going concern. That means any of these indicators you have found. Or there may be a case you did not find any events or conditions which create a doubt regarding going concern. If you don't find any of these events which create a doubt regarding going concern, that's all, your responsibility has come to an end. You aren't supposed to do anything. In case, if you came to know about any of these events or conditions which created a doubt regarding going concern, then you need to perform further audit procedures. Sir, what further audit procedures I have to perform? Right. So see here, what further audit procedures I have to perform. The list is there given here. So the further audit procedures which you are required to perform, or where management has not yet performed an assessment of the entity's ability to continue as a going concern, go and request the management to make its assessment now. The management has not yet done the assessment, go and ask them, sir, why you have not done the assessment? Please do the assessment now. And evaluate management's plans for future action. Sit with them. What are their plans for the future? Check them. Don't just get the plans, check how far they are feasible. The company is telling, sir, we have borrowings. You found that companies approaching borrowings are approaching maturity. They don't have funds to pay. They told that, sir, a banker is ready to give us some amount of loan. Don't just blindly believe. If the banker is ready to give the loan, ask them to do the sanction letter. So try to check how far that plans are feasible. And also ask the entity to prepare a cash flow forecast for the coming 1 year, how the cash flows are going to be. So prepare a forecast and check on whatever data that cash flow forecast is prepared, is it reliable or not? On whatever assumptions that forecast is prepared, or those assumptions are realistic or not, you obtain that evidence. And check whether any additional information has become available from the date management made its assessment. Management made the assessment, gave it to you. After that, any significant event has taken place which will create a doubt regarding going concern, analyze it. And also you have to request written representation. And in addition to that, you need to perform additional procedures like analyze the cash flow, profit, and all other relevant forecasts. Check the entity's latest available interim financial statements. Go through the terms of the debentures and loan agreements. Read the minutes of the meeting. Go and inquire the entity's legal counsel, and also existence of arrangements, financial arrangements with the banks and all also you have to verify. So finally perform all these further audit procedures. Now you will be left with the findings. What findings? Going concern is valid, invalid, material uncertainty, blah blah blah. All that will be left, and depending on that findings, you have to fulfill your reporting requirements. Understood? So SA 570 we have completed. That's it. Next. Now we will talk about SA 560, which is relating to the concept of subsequent events. Right. So what are these subsequent events? These subsequent events we already know. In the accounting, you might have already learned that subsequent events. So what basically is the meaning of subsequent events as per accounting standards? We'll come to the standards on audit later, but as per the accounting standard, what is the meaning of subsequent event? Those events which are occurring between the date of the financial statements and the date of approval of the financial statements, that we call them as subsequent events. And accounting standards divide that subsequent events into two categories. What are they? Adjusting events, non-adjusting events. What we should do to the adjusting events? We have to adjust it to the financial statements. Non-adjusting events, disclosures we have to give. So like this is what they have told it in the accounting standards. And as we all know, accounting standards will talk about accounting requirements, not auditors' responsibilities. Whereas standards on audit talk about auditors' responsibilities. So in case if the auditor came across any subsequent events, what he is supposed to do? We know what is the meaning of subsequent events as per accounting standard, but that is not the meaning of subsequent event as per standards on audit. The term subsequent event has been defined under standards on auditing in a different manner. So what is that meaning of subsequent events? But before we could see that what is the subsequent event, we need to understand few dates. Few dates we have to understand. So what are that dates is, number one, date of financial statements. What do you mean by date of financial statements? The date, the end of the latest period is nothing but 31st of March. In India, that will be 31st of March. So if you take 24-25 financial year, 31st of March of 2025 will be date of financial statements. Date of approval of financial statements. The date on which the recognized authority has accepted the responsibility. Basically, whenever board of directors will sign the financial statements, that is when they have accepted. So say for example, date of approval of the financial statements is 10th of April 2025. Then we have date of auditor's report. What is the date of auditor's report? The date which auditor signs and mentions it on the auditor's report. Say for example, 15th of April. And then date the financial statements are issued. What do you mean by that? The date on which the financial statements are made available to third parties. Apart from management and auditor, whenever these financial statements are being made available to third parties, that date we call it as date the financial statements are issued. Say for example, these financial statements are issued, audited financial statements are issued on 20th of April. Clear? And basically between the date of approval of the financial statements and the date of auditor's report, which one should be earlier? Date of approval of the financial statements. It could be on the same day also, but the date of approval of the financial statements cannot be later than date of auditor's report. Fine. So we understood all these dates. Now let us try to understand what is the meaning of subsequent events. So SA 560 says that subsequent events are those events which are occurring between the date of financial statements and the date of auditor's report, but the fact which became to auditor's knowledge after the date of auditor's report. Some event has taken place between the date of the financial statements and date of auditor's report, but the auditor came to know about that fact after the date of auditor's report. Then only that event we call them as subsequent events. See, if some event has taken place between, if you go back to this dates only, some event has taken place from between the date of financial statements and the date of auditor's report, but auditor should have known after this. If the auditor has known about this event before the date of auditor's report only, there is no requirement of standard. There is no requirement of any guidance only. Why? Because if you came to know about the event before giving the audit report only, whatever action you want to take, that action you can take it through your auditor's report only. So or no? So why do you need a separate standard for that? Not required. No. So when we need guidance, when the things become complicated, you already gave the audit report, you already signed the audit report, then you got to know about an event, but that event has taken place in the past. So now the need will come. Now you start looking for guidance. Have I got to know about this information at the time when I have given audit report? I would have given a different audit report. So that thought comes to your mind. Now you have to take some action. Now you have to start looking for guidance. So that's why subsequent events are those events which are occurring between the date of financial statements and the date of auditor's report, but the fact came to auditor's knowledge after the date of auditor's report. Clear? Next. Okay, we understood subsequent events. Then yeah, what are the objectives of the auditor? As an auditor, what are your responsibilities? So you need to understand, you need to obtain, you need to check whether subsequent events that require adjustment have been properly reflected, whether if there are any subsequent events that to adjusting subsequent events are there, whether they are properly reflected in the financial statements or not, you need to check. And in case if you came to know about any subsequent event after the date of auditor's report, you have to respond appropriately. How to respond appropriately, that's what we are going to learn. And whatever it is, first you need to find out subsequent events are there or not. First, how you will get to, in order to know whether there is a subsequent event or not, to know that you need to perform some procedures. So what audit procedures you will perform to know whether subsequent events are there or not? So we have a list here, as you could see. First, you should go and understand what procedures management has followed to identify the subsequent events. See, before the auditor, management is having a responsibility to identify the subsequent events. So first go and ask the management what procedures they have performed to identify subsequent events. And also go and inquire with management and those charged with governance. Did they find any subsequent events? And also read the minutes of the meeting of board of directors and shareholders, especially which have taken place after the date of financial statements. Read the interim financial statements, quarterly financial statements, if they are ready, read them, or even obtain written representation. So you perform all these steps and you have to find out the subsequent events. Now you will find out the subsequent events, and there might be two cases. See, you have found out a subsequent event after the date of auditor's report. You gave the audit report on 15th of April. After giving the audit report, you got to know about subsequent event. But by the time you got to know about subsequent event, financial statements are not yet issued. Financial statements have not fallen in third party's hands. That is one case. Second case is you have got to know about subsequent event after the date of auditor's report. But by the time you have got to know about the subsequent event, the financial statements have already been issued. The financial statements are already in the hands of the third parties. Which one is more complicated? Second case is more complicated. First case is somewhat better. Why? Because you got to know about subsequent event, but the financial statements did not reach anybody. So the moment financial statements reach the third parties, then the things get complicated. So first we will talk about the easy case, facts which became known to the auditor after the date of auditor's report, but before the financial statements are issued. Generally, if you came to know about, generally whatever things which take place after the date of auditor's report, you are not required to worry about it. You don't need to do anything. But in case if you came to know about any fact, and if you feel that if this I have known at the time of auditor's report, I would have given a different audit report. If such a fact comes to your knowledge, then you should perform these procedures. So you got to know about subsequent event, but by the time you got to know about subsequent event, financial statements are not yet issued. What you should do? So what you should do here is three things you should do. Number one, first go and discuss the matter with management. Go and discuss with the management. Sir, I got to know about subsequent event. What we shall do? Discuss with the management. Determine whether financial statements need amendment. As a part of the discussion, you please determine is that a adjusting event or non-adjusting event. Why? Because only when it is adjusting, then only it requires amendment of the financial statements. So arrange a discussion with the management, discuss with them, determine as a part of the discussion whether financial statements need amendment, and if financial statements need amendment, if you have decided that financial statements need amendment, you have to inquire whether management is ready to amend that financial statements or not. You have to inquire them whether the management is ready to amend financial statements. Now, two outcomes could be possible. First, three things. What you will do? Number one, discuss with the management. Number two, determine whether financial statements need amendment. If needed amendment, then you need to determine whether management is ready to do it or not. Two outcomes could be possible. What are they? Management agrees to amend the financial statements. If the management agrees to amend the financial statements, happy. But you should do one thing. What you should do? You should perform extra procedures to check whether they have done the amendment properly or not. The management says, yes, sir, we have done the amendment. You can't blindly believe no. So you should check at least once whether they have done the amendment properly or not. You need to perform audit procedures. You need to obtain audit evidence regarding that amendment. If everything is okay, you will give unmodified opinion, no issue. That means old opinion itself will become relevant. But you have to do one small change here. You have to do one small change. So management has amended the financial statements, and it is you are happy that they did the amendment also properly, but you are not required to give any kind of modified opinion. The old report is still valid, but one slight change you have to do. Date you have to change. Why? Because previously management approved the financial statements on 10th of April. I gave the audit report on 15th of April. Now we got to know about subsequent event. Management amended the financial statements. These amended financial statements will once again be approved. Say for example, these are approved once again on 20th of April. So now that is other case, no? So 20th of April they have amended and they have approved it. The old audit report content and all wise it's same, but I can't give the old audit report. Why? I have mentioned the date as 15th of April. So what I should do? Keep the entire report as it is, just to change the date and give the audit report. Clear? Able to understand? So what we have seen, once again, if you understand the cycle here, discuss with the management, determine whether they need amendment. If financial statements need amendment, inquire. Management agrees to amend, perform the audit procedures on the amendment, try to obtain sufficient and appropriate audit evidence, and then finally there is no impact on the opinion. Old audit report will still remain valid, but only one thing you are required to do, change the date. Now the problem comes. What is the problem? Management is not ready to amend the financial statements. If the management is not ready to amend the financial statements, now also here there could be two cases. See, now you can't give the old audit report. What you should do? You should give a modified opinion. Why? Because management is not amending financial statements. You have to definitely give a new audit report. But here also there could be two cases. You signed audit report. Audit report is ready, but you have not yet handed over that audit report to the client. You signed audit report. Say for example, on 15th of April, you have signed. You thought tomorrow I will come and give that audit report to my client. But before you could give that audit report to the client, you got to know about subsequent event, discussed with the management. Management is not ready to amend the financial statements. You are in a favorable position here. Why favorable position? The report is still with you. You did not give it to the management. What you will do here? Whatever old audit report is there, you throw it away. You give a new audit report. In that, give a modified opinion, add your signature, fix your UDIN and all, and give that new audit report. But In some cases, so if you see this, management does not amend the financial statements, but there are also two cases. Audit report is not yet given to management. Then what we do? Modify the opinion and give the audit report. What is the other case? By the time you came to know about subsequent event and all, audit report has already been given to the management. So I have given the audit report to the management. I got to know about subsequent event. That subsequent event needs amendment of the financial statements. Management is not amending. Now what I should do? First thing what you should do is you should instruct the management not to circulate audit report. Don't circulate the audit report until my further notice. Then what if without listening to you, if the management has still circulated, what you should do? You have to take appropriate action to stop the people from relying on the auditor's report. Whatever action you will take, that you will decide. So you have to take the appropriate action, whatever it is. Take appropriate action and stop the circulation. And anyhow, so you should stop the circulation. If first you should instruct the management not to circulate. If circulated, please take the action to stop the circulation. Then what you should do? Give a new audit report which contains a modified opinion and ask them to circulate this new audit report now. So this is what, in case if you came to know about subsequent event before the financial statements are issued. Now let us come to the another case. What is another case? You came to know about subsequent event, but by the time you came to know about subsequent event, financial statements are already issued. They have fallen in the hands of the third parties. Here what you will do? Here also the same three things we will do. First we will go and discuss with management. Then we will determine whether financial statements need amendment and inquire whether management is ready to amend the financial statements or not. But before that, what you should do is, if you have decided financial statements need amendment, whatever audit report which is there with the shareholders, that is not a valid one. So first you should go and ask the management, sir, take some appropriate action to stop the people from relying on the audit report and the financial statements. What you should do? You should go to the management and ask them, sir, please stop the movement, please stop the people from relying on the audit report and the financial statements. If the management does not take any action, then what you should do? Auditor himself should take an action to stop the people from relying on auditor's report. Understood? So whatever it is, first stop the people from relying on auditor's report. Either you do it or management will do it. Someone has to do it. Then after that, once again, I will see whether management is agreeing to amend the financial statements or not. If the management does not, if the management agrees to amend the financial statements, well and good. What I will do? I will perform the audit procedures, whether they have done the amendment properly or not. I will try to obtain audit evidence. Then I will give new audit report. I will give which contains unmodified opinion only, because they have changed it. No. And here the standard specifically says you will give unmodified opinion. Now this audit report will go. Amended financial statements will go once again. But the shareholders already have a copy of the financial statements and the audit report. Now if you send them new copy of the audit report and financial statements, they get confused why we are getting two copies of the financial statements and two audit reports. So in order to sort out, in order to help that shareholders, what you do is you either use an emphasis of matter paragraph or other matter paragraph, mainly emphasis or other, whatever it is. You use that emphasis of matter paragraph or other matter paragraph, and there you highlight. What you do? There you highlight what is the difference between this new set of financial statements and the older set of financial statements. Just highlight it. You give unmodified, but highlight it. What if the management doesn't agree to amend the financial statements? What if the management is not agreeing to amend the financial statements? Anyhow, you will give a new audit report, give a modified opinion. Reason for that modified opinion, you will explain it in basis for modified opinion paragraph. Here also, are you required to make use of any emphasis of matter or other matter paragraph? No, you are not required to use any emphasis of matter or other matter paragraph. Okay, everybody with me? Shall we proceed further? Right. So this is what regarding SA 560. So with this, we have completed all the 500 series of standards. One small point I missed out. In SA 570, reporting requirements are there, no? We have seen two cases. Going concern is valid, going concern is invalid, material uncertainty relating to going concern. Now one slight change there, not change actually, addition. So if you come to this, going concern becoming invalid. If the going concern is invalid, there also we try to check whether there is an appropriate disclosure or not. If there is an adequate disclosure, what we do? Unmodified opinion we will give. If there is no adequate disclosure, what we do? Directly we give adverse. See, even in the case of material uncertainty also, If you are modifying, if there is an adequate disclosure, we are giving unmodified. But in order to bring that matter to the shareholders' attention, we are highlighting that there is a material uncertainty. Where we are highlighting it? In a dedicated paragraph called material uncertainty relating to going concern. Don't you think here also there is a need? Going concern is inappropriate. Going concern is invalid. Entity will not continue for the foreseeable future. Management has given an adequate disclosure also without their fault. I have given an unmodified opinion. But don't you think here also there is a need to highlight this information to the shareholders in the auditor's report? Yes. How to highlight it? Here they have told use the emphasis. Here there is no need to use any separate paragraph. Here you can highlight that in which paragraph, in the emphasis of matter paragraph you can highlight it. Understood? Only for highlighting material uncertainty we use material uncertainty relating to going concern paragraph, but for the purpose of highlighting inappropriateness of the going concern assumption, no need to use any separate paragraph. You can highlight it in emphasis of matter paragraph. Understood, right? So this one small point I have missed out. So with this we have completed all the 500 series.